Good afternoon, everyone. Welcome to the side stage opening on the second day. We will be welcoming Christoph Jens. He's the CEO and the co-founder of Tokenize It. And he will be talking us about how can we crowd invest with GmbH tokens. Thank you so much. Please give a round of applause for Christoph.
Yeah, thank you for the invitation. It's great to be here back at DappCon. I think I've spoken at every DappCon since the beginning. So it's, I think, the best Ethereum conference in Germany, so it's really great to be here. So I want to speak about GmbH token and how you can tokenize your GmbH. But let's step a little bit back to look at history. So taking you a little bit through the journey, how I came here and from where I'm coming from. So if you think about Bitcoin, I discovered Bitcoin in 2013. I know there are some people here who hate it, some who love it. I still like it. So meaning Bitcoin has this brought digital ownership to the mass. Let's say not to the masses, but to a lot of people. We for the first time understood that you could digitally really own something. In 2014, we got Ethereum. And there is this snippet in the Ethereum white paper where Vitalik basically predicted that a lot of tokens will be built. There's a bit of pseudo code. It's not directly the ERC20 standard. This was not defined in the white paper. But he already predicted there will be lots of tokens for all kinds of use cases. So back then, we just called them your own currency. And I still like the Ethereum white paper a lot. If you read it, almost everything in there got fulfilled. It is like a prediction of the future, from DAOs to ENS to tokens. The only thing I think Vitalik didn't predict was NFTs, but anything else you can find in the Ethereum white paper. So this was the beginning, that you now could say, for those who have been around during the time, before Ethereum, people actually started building their own chains per token. So you had Prime Coin, Namecoin. So if you want to do any application, you start your own chain with your own consensus, with proof of work, later on proof of stake. So Ethereum solved that problem that you now already have a chain, which is stable and robust, with a stable consensus layer, that you can build your token on top of. So in 2016, I was most known for the project, the DAO. So we took it to the most radical approach, if you want, fully decentralized, just a smart contract. Everybody could put Ether in, get a DAO token out. That's not a topic of my talk. You know what happened. There was a bug in the smart contract, and we got a hard fork. Another story for another day. That's now almost 10 years ago. But what we learned from that, except of course, smart contract security, is that the fundraising mechanism, using a token to fundraise, worked like a charm. And what happened after that? After that, we had this ICO bubble. You see this little dot here in 2016, this 160 million. But what happened afterwards was billions of dollars were raised using tokens. Many of those projects were scams, bad projects. Some of them were good. Again, another discussion is how good or bad ICOs were. But still, the fundraising mechanism of letting people buy your token, they can see the market cap on Etherscan. It's all completely transparent. It's all digital. So you don't need a notary or anybody like that. And they can see exactly to what terms the token is technically tradable if there's a market. So those aspects of the ICOs and DAO times was really great. Yeah. So, but what did we get afterwards? So you see it going down in 2018 or so. Well, SEC came, BaFin came, and others saying most of the tokens are most likely securities. And I'm not a lawyer, I don't want to speak to this point directly, but what happened to most of those projects, or what was the legal setup? Not all, again, many are different, but most of them, did you choose a non-profit foundation in Switzerland? And the reasons for those is that you do not want to have two cap tables. And I'm also strongly advising against doing a for-profit entity, let's say a GmbH or AG, and then you have a utility token next to it, or any kind of token, because as an investor, you have no idea where the value is. The CEO of this company has a lot of power to direct the future value towards increase in token price or increase in company share price. So two kind of cap tables is always, for me as an investor, an absolutely no-go. So I won't have one cap table. So, and this was the reason why they went for non-profits, because in non-profits, those shares have zero value. They are actually owned by the state to some extent in Switzerland. So this is the non-profit foundation, and then they tried to make tokens, and to connect the token price to the product, roughly speaking, they just capped the amount of tokens existing, something like 100 million, and said, in order to use the product, you need to have a token. So if the usage of the product goes up and there's a limited supply, means the value of the token goes up. This was roughly the model we saw at the time. And you can argue now about some of them are security tokens, some not, depending what you do. But ironically, even though those projects wanted to give the token holder dividends and real value and exit participation, liquidation proceeds, they could not, because then it would look like a security. So those investors, if you look at the paperwork, they donated to a Swiss nonprofit and actually got a donation receipt. And a paper saying this token is nothing, will be nothing, has no value, and whatever. So, and this is actually ridiculous. And investors put money into those kind of tokens. So this was not a good situation. So we looked into how can you like redesign the system and don't make it too complicated. And I like this quote by Buckminster Fuller, who said, "You never change things by fighting the existing reality. To change something, build a new model that makes the existing model obsolete." So we are based in Germany, so we looked at the German GmbH and what you can do to tokenize it. And if you would go to a lawyer, they would say, go somewhere else, like go to Estonia or go to Cayman Islands or Switzerland. And you can still do this, but it's a tax hassle. It's just a hassle to change the location of a company or having something abroad. So we look to how can you do it in Germany for a startup, which is a GmbH. This is something we've worked on now for almost 3 years, and I think we have solved it. And so in the next slide, I have one slide with all the information about what is this GmbH token. So it's a little bit dense, but if you understood this slide, I've got most of the information what I wanted to convey today. So the GmbH, first of all, you cannot tokenize a real GmbH share. Those shares are on the commercial register called Handelsregister in Germany, and only the notary has any access to it. That's a problem we all know. But what you can do is giving out something called participation right, or in German Genussrechte. So we are using those, or we can also call them profit participation rights, and they include dividends, exit proceeds, liquidation proceeds. So if you sell the company or if you liquidate the company. This in essence means every financial right or economic right the shareholder has, the token holder has as well. So every time a shareholder gets some money per share, the same amount of money per token goes to the token holder. Meaning one token always has the economic value of one company share. Plus, the token holder gets some basic information rights, like the annual financial report. And one additional thing, which I think is very important, this is a put option to give the token back to the company and receive an actual company share. This, of course, has to happen at the notary, and we do not think this is done very frequently, or it's actually only needed if you need governance rights. Because governance rights to truly make decisions in the company cannot be given out through those Genussrechte or participation rights, so you can only get them by actually converting your token to an actual share. So in essence, a token holder has the same economic rights as a shareholder, plus he has a way to convert the token into a share. So with this, token equals company share. Technically, I don't have to speak too much about this here because it's simple for all of you. It's an ERC20 token on a public Ethereum chain. For crowd investing, we are actually using the Gnosis chain since there are cheaper gas costs and nice Monerium integration and good safe support. That's why for crowd investing, starting with a 200 euro minimal invest, we're using Gnosis, but for the other things, it's on Ethereum mainnet. It's an ERC20 token with admin rights for the CEO, so you can burn and mint tokens. There's an allow list, which he can or cannot use. If it is used, then only those on the allow list are allowed to hold the token or send and transfer the token. There are lockups, so you can say to an investor, you cannot transfer the token for a certain amount of time, and all of this is smart contract enabled. Also vesting contracts for employees. All of this on-chain. So with this, you have a token which gives you full access to the DeFi ecosystem. So we are currently looking into how we can integrate this into DEXs, talking with PWN, how you can use your token, for example, as a collateral to give yourself a loan. So all those nice applications are now possible because you have a digital token on Ethereum. And now a very important part, how we connect the legal part and the technical part. It might sound a bit boring, but a lot of those security tokens had a problem that legally there's always an investment contract between a buyer and a seller. Even it's explicitly, like in a document, or it's implicitly just by doing this trade. The problem is, if, let's say, my 9-year-old daughter is transferring the token, she's not legally entering into this investment contract. Meaning there is this worst case scenario where the token is technically transferred, but the legal rights are not. And this is the main problem of many security tokens. So how do you solve this, that there never will be like a dissolvement of technical token and legal rights? Solution to this problem is something called public reward, or in German Auslobung. So Auslobung is the BGB in the German law. It's a very simple thing, but powerful. It says you can publicly announce that you are rewarding a certain action. So for example, if you find my physical wallet, I give you 1,000 euro. If you solve this mathematical puzzle, I give you 1 million euros. The nice thing about this is it's a one-sided contract. I'm making the statement, I'm signing this, I'm saying this. It's legally binding even though you didn't sign. But if you fulfill the requirement, you can take me to court if I don't give you the reward. And we're using this mechanism that the GmbH is publicly announcing that it will reward the action of holding the token with dividends, the action of sending the token back to the GmbH with the put option. So you get those legal rights based on an action you can only do if you hold the token. And the action itself is trivial. You just push a button on a web app. So with this, it doesn't matter how you got the token. If it went through a DeFi exchange or whatever, if you have the token, you can always claim your rights based on this public reward or Auslobung. And you don't have to prove there's a valid chain of investment contracts. Because if this token gets traded, you have hundreds of owners. Legally, you would have to check if all of them legally entered into the investment contract, that they're all correct, which is practically impossible. But now with this public reward or Auslobung, you do not need this. So, and this is a very, very strong connection. We have worked a lot to figure this all out. So but the end result is you now have an ERC20 token on Ethereum, which is representing economically a company share, and it's always linked. So what can you now do with this? Well, first, it allows for something I like to call continuous fundraising. We often think about pre-seed, seed, Series A, B, C, D, because it's just such a hassle to raise around. But here you can continuously invite someone to invest. You just send out a link. Here you can invest 100K at a 10 million valuation. Here's your link. And you can individually close the deal. And then you can go to the next, to the next, and to the next. And we have now closed over 100 private investments on our platform. We have one power user, he closed over 30, we have closed over 20. So it's super simple over the span of a year just to continuously fundraise at your terms. It's technically tradable. You don't need any notary. It's an ERC20 token, and you can just use your Ethereum wallet, hold the token, and give it to someone else, and they pay you. It's what I like to call programmable equity. Ether, we like to call programmable money, and this is programmable equity. So you can do if this, then that. Meaning you can reward your community. If they log into if they use your application, you can reward them with tokens, with 0.001 point token, something like that. So meaning you have now a very, very powerful tool for incentivizing your users. And you have one asset for all stakeholders. Currently in a GmbH, you often have the actual shareholder, let's say the founders. You have an employee who has a VSOP, then you have an investor who has a convertible loan. They are part of your company, they invested, but they have different assets, so they cannot trade. And with this, you have one token, similar like an HG has stock. Now you have for the GmbH, you bring the same advantages which a HG has into the GmbH. Okay, now getting into regulation, one slide. So when you make an offer, technically, you need a prospect. And there are a list of exceptions, and two of them, they are the most important ones. We are using them on our platform. First, if your offer is only directed towards less than 150 investors, you do not need a prospect. what we call the private offer. So business angels, family and friends, VCs, and so on. Meaning on our platform, you would just create, if there's some time, I might show you in the end, say those are the terms. This is the one the private offer is for. You're creating a link, sending the link to this investor, and he can then individually close this investment. So up to 150. If you want to do a public offer, and that's also one of the main achievements, what we like to call crowd investors, similar to an ICO in spirit, you can up to 8 million euros per year using something called a key information sheet, in German Basisinformationsblatt. And we are providing this with a broker license we have through a liability umbrella. So we are making sure it's compliant with German law. And on our platform, you can just raise publicly up to 8 million per year. This means you can have an Invest Now button on your website. So every time your users or those interested in your product are on your website and they like it, they click the Invest Now button, they see your current terms, they can just invest with a minimum of 200 euros. You can spread the word in social media, really shouting out, you can invest in my company. And this is legally compliant, up to 8 million per year. And this is really what we had with ICOs, just in a legally compliant way. Okay, now what are the applications? I already mentioned them, so to summarize them, you can do a private offer, meaning create an individual link for an investor with individual terms for up to 150 investors, with an expiration date, and continuously fundraise over a certain amount of time. You can do employee participation, which is tax optimized in Germany because the employees only pay income tax when they receive the token, and afterwards only about 25%, in German Abgeltungssteuer. So it's much better than those VSOP programs. VSOP, they always pay income tax. So tax-wise, the best way to have your employees participating in your company. And we have smart contracts for vesting and cliff, and everything happens on-chain. And we have legal template provided by our lawyers, so you don't have to pay lawyers for creating those legal docs. They are all on our platform as templates, and you can use them as they are. And of course, we do not do legal advice. You can still ask your lawyer if they are correct, but technically they have been prepared by our lawyers, and we trust them. So, and then the last one, most importantly, crowd investing. So you can set a term such as price per token, max amount of tokens to be sold, and you can at any time just pause the fundraising if you have enough funds. If you still say, I need more, you can open it up again. If you urgently need money, you can decrease the price. If you have enough money, you could also increase the price. So you can change those parameters always with a 24-hour time window before to avoid any, or at least 1 hour time window before to avoid any MEV bots or other things. But you can always just change parameters and have a continuous public fundraise through Tokenized. Okay, so that's it. Our vision or our mission, we enable everyone to become a co-owner of a company. So we started now with the GmbH. The product is completely live with all of the features I just explained. Everything is there today for you to use. The next is to go to other European countries. And my vision is to be something like a Web3-based AngelList for Europe, if you want. So meaning that all those legal entities we have in Europe, those which are private, like the LLC, ÖÜ, SAL, in Germany, the GmbH, that we customize this setup for each of them and then allow for all of them in Europe to fundraise through tokens. And I think it's totally possible. We have proven it, that it's doable also from a legal point of view, in a compliant way, and you have this ERC20 token on Ethereum. So I have 1 minute and 40 seconds left. Let's give you a very quick demo of our platform, and just let's create a private offer. 1 second. Let's connect. So you can connect on a platform with your wallet, but using Web3 Auth in the background, we can also create a multisig for you using your social logins. So for those Web2 users who have no idea what a wallet is, they can also connect with Google if they want to. So I'm showing this here in the background, but you can also use your MetaMask, hardware wallet, whatever. So I'm now logging in as a founder. For time reason, I'm skipping the onboarding process. So I'm now already onboarded. I can now look at all the private offers, my employees, and the crowd investing, or I can create one of those, like a private offer vesting plan or crowd investing. So now let's just create a private offer for an investor. I can choose if he gets a range of tokens he can choose from, or if he gets a specific token amount he can buy. So let's give him the right to buy 100 tokens. I call them here Pied Piper coins, PPC. We are using stablecoins such as USC and USDC. For crowd investing, we have integrated Monerium, so we're using EURE there, which is a very, very nice user experience. They just do a SEPA transaction, we get a stablecoin, push them through our smart contracts, and we're done. All with SEPA instant in seconds. So it's a super nice user experience for the crowd investor. So all pieces are coming together right now. Like from Monerium, knows is safe. Also that we have regulation which works for us. We don't need to love the regulation, but we can comply. It's possible. So we have the specific amount, let's say 100 tokens. I'm choosing EURC, for example. The price per token is my price per company share. So if I have, for example, 25,000 shares in the commercial register, this means now if I put 1,000 euro as price per token, I value my company at 25 million. So I continue. I'm giving a duration. Let's say this is valid for 1 month. I'm choosing, don't know, Andresen Horowitz. He can now, if I don't know him personally, I could require KYC, then he has to go through an ID Now check. But for private offer, you don't need to do this, because if you know them personally, it's fine. It's just a help function here. You can do a lockup. In that case, the tokens are locked up during that time period, for example, 1 year or 2 years, where they cannot transfer the token. I'm choosing to have it freely transferable. So then you see the fees in the end. We are charging a 2% fee on the cash amount, which is way cheaper than your lawyers, I promise. And so then you see the complete, you also see the company valuation here. It's very small, you cannot really see it. You cannot, you can see it, okay. So if this is all fine, you click agree and create private offer, and you get this link. And this link is what you share with your investor. He will just see company valuation, investment amount, your legal docs, where you can download them. He can also see your pitch deck if you uploaded one, and then he can choose yes or no. If yes, he sees either your wallet, where you can transfer the EURC, or he sees the IBAN if you choose bank transfer, and just transfers the money, and that's it. And so you can continuously fundraise, and very, very similar for the crowd investing. The only difference here is that we have to do a suitability check, some more AML stuff, but it's all happening in the background. So that's it. We're very proud of this product. I hope you're using it. So thank you very much.
I think we have time for 1 or 2 questions.
There's a mic.
Thank you for the presentation. I have a question about the tax law perspective on this, because the dividends are usually withheld. In a normal dividend would be withheld with 26.375% in Germany. And with this dividend, for example, when you transfer, we also be withheld in the platform. And also, yeah.
So the dividends, so the short answer is, tax-wise, the GmbH token work exactly like GmbH shares. That's the short answer. To a dividend, in Germany in the GmbH, if you pay out dividends, you need to have a shareholder resolution with a date. And what we do is, only if you hold the token at that date, you will get the dividends. So if you sell 1 day later, you are not selling the dividends with it. Basically, the token, if you hold the token at that date, we are doing a snapshot on-chain in the token contract. And then on the next day you are selling, then you will be eligible for dividends, and you can claim them later. And you're paying the same amount of tax as you would if there's a GmbH paying you out dividends as a shareholder, depending if you do it as an entity or a private person. Yeah, so ask your tax advisor, but it's essentially the same.
Okay, thank you.
Yeah, he was the first. We can do it afterwards. No, let's go ahead, but just that we have 1 more question for him then.
Yeah, lovely service. I can't wait for you guys to come to Netherlands, where we're based. So you mentioned continuous fundraising, but at the same time, you're also talking about putting a price on the token, which is linked to the share price. So I'm familiar a little bit with the US system, so I don't really know how it works over here. But there, for private companies, you go through a 409A process to set the share price before you're public.
But not if you get an investor in. Like if you get an investor, it's basically you're negotiating a deal. Like my company is worth 10 million or 20 million. What you're referring to is from a tax perspective. If you, for example, give employees shares, they need a valuation which is valid for the tax officials. And here, yes, either there's three ways to get this valuation. You can get a Wirtschaftsprüfer, like someone who checks your company and just puts a price on it. Okay. Number one is similar to the 409A valuation. Or if the tokens are actively traded, in that case, you can use this as a reference price. Those are the two options you have. But you only actually need this valuation when the employees are minting the tokens, because then they have to pay income tax based on that valuation. But for the investors or for the crowd investors, you don't need that. So do we have one more question?
We have a few more. I think we have time for maybe one more.
Hi. How do you think about the governance rights of this whole thing? Because like it seems like as a traditional investor, I would kind of like I would look at your model and I'd be like, okay, I can't sit on the board. There's no way for me to actually have governance, like kind of an influence on what this company does. So how, like, is there like an implicit understanding?
There's two solutions for this. So first of all, legally they don't have any governance rights because they couldn't do it. But as long as they have a good relationship with the CEO, they can still talk to them, and they can do on-chain voting using Snapshot and so on. They can still do all of those things. It's just not legally binding. So, but if you say, well, the CEO is not doing this, even though he made a vote and he doesn't do it, I can convert to actual shares and be an actual shareholder and have real governance rights. So this is like like speaking from a game theory point of view. Why should the CEO say, I'm not doing this, if you can just convert to actual shares and then actually get legal voting rights? So if this is the case, then I would just accept the token voting and things like this. And at the last, for investors, you can still have a side letter with individual investors. I'm just not with the token, so it's not transferable. But let's say you're a VC and you want to invest and you have some different terms or want to speak about veto rights or something. You can have a side letter, and we do this as well as Tokenize It, where some investors, for example, have veto rights if you would sell the company or stuff like this. So they can get individual governance rights through an agreement, which is dependent on them holding a certain amount of tokens, but it's not bound to the token itself. So if you would sell the token to someone else, he would not get those governance rights. But as long as you have a certain amount of tokens, based on the side letter, you can have some governance rights. That's usually for larger VCs. For crowd investing, it's less relevant.
Okay, thank you so much. All the other questions, I think they can approach you directly.
Yes, I'm here.
Christoph will be around. So thank you so much for the amazing presentation. And we will wait 5 extra minutes for the upcoming presentation. Please don't get too impatient. It will pass. Time will pass fast. So thank you. Can I now? Yeah. So actually, we will be starting a bit earlier. So if you can please make silent for our upcoming presentation. we are now welcoming Nicholas Kunkel. I hope I'm pronouncing
That's
well. Nicholas is the founder of Chronicle Labs, and he will be explaining us how can real-world assets be the answer to the DeFi boom-bust cycle. So please give a round of applause to Nicholas, and thank you so much.
Thank you. Okay, so quick background on me. My name is Niklas, was part of the founding team of MakerDAO, and kind of taking a look back to 2016, 2017, right, when DeFi was still in its infancy, right? It all started very small, right? So at first it's like, well, there's going to be this kind of parallel financial system, and we're going to need to be able to exchange value. And crypto is volatile, right? And so we're going to need some stable means of exchange, right? And so, okay, stablecoin is kind of primitive number one to creating a DeFi ecosystem, right? But in trying to do so, there was an enormous amount of other things that had to be built out first, right? So, we will need a means to kind of exchange these assets in a decentralized way. So we created the first DEX on Ethereum. Actually, I don't think many people know that. Maker actually created the first DEX on Ethereum before Ether Delta, before any of this stuff. And then you get to kind of the next step, and it's like, oh, well, like in order to have this stablecoin that's backed by Ethereum, right, you need to know what is the price of Ethereum, right? So, okay, you're going to need an oracle. So Maker made the first oracles on Ethereum. And then, right, it's like, well, you know, I wish I could like debug my code without just deploying my contract on chain, seeing an out of gas error, and still having no idea why my function failed, right? So okay, so I make the first like Solidity debugger. And so fast forward a few years, right? We've kind of released DAI, and it's exclusively backed by Ethereum, right? The most decentralized collateral, and we run into the first problem. And what is the first problem? Well, there is only so much on-chain activity. There's only so many people actually using ETH on-chain. There are only so many people willing to take risk in DeFi and actually utilize their ETH instead of having it just safely sit in a wallet. And so we hit kind of this level of like 80 million Psi, which was the name for single collateral DAI, and it looks like we've just topped out, right? There's no growth left. And it's like, well, this kind of sucks. How do we fix this? And so the solution was, oh, well, clearly we just need a stablecoin 2.0, right? We need a multi-collateral DAI. We need to expand what DAI is backed by more than just ETH, right? It should be backed by other altcoins, right? It should be backed by things like Bitcoin. It should be backed by stocks, by bonds, by commodities, right? And this way, right, it wasn't just a way to open a means for growth, right? But it was also a way to diversify the collateral portfolio to help stabilize, right, and de-risk the peg breaking for the DAI stablecoin. But okay, so you release multi-collateral DAI, and what happens, right? You start onboarding a bunch of altcoins, right? And you quickly find that you run into problem number two. Compared to, you know, outside of ETH or something like WrapBTC, there's really not that much total addressable market if you start combining all of the altcoins that can be safely utilized as backing for a stablecoin, right? So the growth opportunities were quite slim. And so you're back at problem number one, right? Like, is this it? Is this the biggest that this thing can grow, right? And all the while, you're going through these cycles. And what are these cycles? Well, the cycles are when you get some kind of euphoria, right, and number goes up, and it just kind of has this positive feedback loop, right? So Maker kind of benefited from this at times, right? Number goes up, people want to get leverage, so they lock up their ETH, they borrow against their ETH, they buy more ETH, right? And Maker gets to set really high interest rates because people are just that bullish on number go up. And that's the positive side of the equation. But actually, like DeFi has this problem, right, in that it's hyper-reflexive. So actually, what happens when number goes up, stops, and number goes down starts? Well, when number goes down starts, nobody wants to have long exposure on ETH or crypto in general. And nobody wants to have, especially nobody wants to have leveraged exposure. And if they do, they don't want to pay very high interest rates, right? So you get into this kind of depression, right? And so at first glance, right, it's just like, oh, big deal, right? Revenue goes up, revenue goes down, who cares? But I kind of want to like give you kind of the second order thinking here, which is that organizations, right, like all of the DeFi institutions, like Aave, like MakerDAO, like Curve, like Uniswap, right, they're all part of this hyper-reflexive cycle. And so when excuse me. So when times are good, you're making hundreds of millions of revenue, right? Great. You do a bunch of hiring, right? You're starting to expand your product suite, right? And then when times are bad, you have to lay everybody off, right? You have to do cost cutting. The future is uncertain, right? Regulatory fears, right? And this is not a very enviable position, right? And so this is what I kind of call the DeFi boom bust cycle. And so I want to talk a little bit about how Maker is kind of has been trying to solve this, right? And so the way that Maker kind of tackled this was to say, okay, well, all of crypto is hyper-correlated, and if you stick with crypto, right, you're always going to be subject to this roller coaster ride of acceleration and dampening. However, if you start using real-world assets, right, which is a non-correlated asset class, right, you can diversify that revenue stream and start to smoothen out that curve. And so in, I would say, late 2022, Maker started aggressively reallocating into real-world assets. In particular, T-bills were quite attractive, right, due to very favorable monetary policy that was happening around the world. And so here's a graph of kind of Maker's crypto revenue. You can see on the bottom it totals 155 million across all the different on-chain collateral types. I think today, actually, that number is at 200 million. And then here is Maker's real-world asset revenue. So these come from treasury bills. These come from lending for US mortgages. These come from, I think, a variety of things. I think there was even a way of extending credit to the contractors that were building like Tesla collision repair facilities in some credit tenant like loss swaps. And this number is also today around 100 million, right? And so you have this very nice like revenue distribution, right? Here, where you can see, like in blue, right, of all of the crypto-backed revenue, and in yellow, right, all of the real-world asset-backed revenue, right? And so you say, okay, like, problem solved, right? Like, we've solved the boom-bust cycle, like, pack it up, boys, and everyone just start doing this. Well, not quite. So the really big problem here is that real-world assets are not crypto native. So what do I mean by that? Well, when you have something like ETH, right, it's entirely encompassed on chain, right? It can be encumbered on chain, right? You can view all of the related data on chain. It's completely custodied, you know, on chain. With real world assets, this is it's the complete opposite, right? And so the challenge here is, how do you make real world assets crypto native, right? Or how do you emulate these crypto native properties such that they become easier and safer to integrate across DeFi? And so while there are certainly more, I think there's kind of 4 main categories here of metadata that is important to either utilize or at least, you know, be aware of if you're not utilizing it, you know, what risks you are exposed to when integrating real world assets. So those are custody, liquidity, yield, and counterparty risk. And so I kind of want to go into each of these a little bit. So let's start with custody, right? When you have a real world asset on chain, typically this is not the actual asset that you have, right? It's a representation of the asset in the real world. And so that asset needs to be custodied somewhere, right? And so you're going to need some metadata stream showing from the custody provider, right, that, okay, these assets are actually in custody, and so this on-chain representation, right, can actually be treated as this asset, right, because the underlying assets actually exist, right? And there are, you know, this is a non-trivial problem, right? Because okay, let's say that there is a corporation just holding these things, or there is some SPV. Well, okay. Who are you trusting to get this data from and to bring this data on chain, right? To then, you know, completely trust that data is correct, right? Now, liquidity, right? With crypto native assets, right? When say the price goes down, right? You can liquidate them on chain, and there is liquidity available on chain either via DEXs or via an army of market maker bots or MEV bots that will, you know, happily scoop up, you know, vast quantities of collateral at a discount. With RWAs, you don't have this, right? Now, you either, you know, with certain real world assets, right, they may just be very illiquid in general, and there may not actually be liquid markets for this stuff, right? Or, you know, in the case of T-bills, right, it's one of the most liquid markets in the world, but the liquidity is not on-chain, right? So you cannot do on-chain liquidations, and so there's a whole mechanism, right, through which of signaling of back and forth to the real world of how to liquidate this kind of stuff. And as a DeFi protocol, right, you need to be aware of this because you don't have those same guarantees. Furthermore, you have all kinds of counterparty risk, right? When you have you know, assets in some kind of SPV, right, or even in some kind of bank, right? What happens if you know, either through corporate greed or maliciousness, or let's say through regulatory action, right? These assets get frozen. Well, all of a sudden you have this on-chain token that you thought was backed by the underlying asset, and now it's not actually there anymore, right? Or, you know, you did some kind of sale through some kind of broker, and like, you know, this shouldn't happen, but the broker just rugged you, right? Or you have some kind of FTX or Alameda situation, right? So, you know, that could take, you know, go into bankruptcy proceedings that could take years to unwind, right? So when you're integrating an RWA, right, you need to consider like this failure scenario that this can happen, right, and that there will be a, you know, multi-year process, right. And to give you an idea, right, the FTX situation still hasn't resolved, right. That's still in bankruptcy proceedings. Mt. Gox still hasn't resolved. That's still in bankruptcy proceedings, right. And how many years has that been? And last is yield, right? And so this is this one is a little more interesting, right? And so I think I think you can make DeFi protocols much more smart with their kind of capital allocation strategies, right? And you kind of see the beginnings of this, right, with DAOs just kind of doing treasury management, right? Like, oh, let me diversify my treasury, or we see a yield opportunity here, let's put some capital over here, right? But this is all done in a manual way, right? And so the automation side of this is extremely important. And what you can kind of do here, right, is, okay, well, if the protocol is aware through like an oracle that the yield is high here and low in this RWA opportunity here, the protocol can automatically, right, reallocate capital from, you know, bucket A to bucket B, right? Let's say the protocol wants to have a certain geographic distribution of risk of where assets are custodied, right? It can say, oh, we have too much exposure in the US. Let's move some capital from this US exposure RWA bucket over here to this one in Singapore, or this one in London, or this one in Dubai, right? And so kind of wrapping up here, I think that the opportunity here is extremely large, right? To not just expand revenue, but really smoothen it out. But there is all kinds of infrastructure that we need to build, and it's primarily going to be powered by oracles. And so oracles are going to be getting much more advanced and much more utilized really as an interoperability layer between traditional finance and decentralized finance. So that's it for me today. I want to thank you all for coming. Quick shout out, I'm the founder of Chronicle. Chronicle is an Oracle protocol. We currently are the second largest Oracle protocol by value secured, securing just under $10 billion in TVL. If that's interesting to you, or if you need oracles, please come talk to me, or please follow us on our socials. Thank you.
Thank you so much. We might have time for one question. Right? Yeah. Okay. Just one second. Sorry.
What ledgers and protocols are you currently integrated with?
In terms of which chains?
Yeah, which chains and which apps?
Pretty much all of the chains. In terms of apps, it's I would say predominantly the largest ones are Spark Protocol, MakerDAO, Morpho, and a few other ones that we haven't announced yet.
Okay. Thank you. I think we are on time, right? Thank you so much, Nicholas. And right next, we will be welcoming, I think we can. Are we on time? Yeah, okay. Right next, we will be welcoming Robert Kosik. Beyond many other things, he's also a researcher at 1KX, right? And he will be talking us about tokenomics of the pins. So thank you so much. Please give a round of applause to Robert. And yeah.
All right. Yeah, let's jump right into it. Who here knows what a DPIN is? Okay, that's fair. Then maybe I spend some seconds on DPINs, right? It's these decentralized physical infrastructure networks. That means you have some physical infrastructure in the back end. It could be a server, it could be an 5G antenna, it could be anything.
and you provide the service, to whoever needs, mobile coverage or whatsoever. And the secret is really you crowdsource the infrastructure. This is the secret. And there used to be like just a couple of them. Early days was Filecoin, Helium. Nowadays there's, I don't know, 700. I lost track. I think a good dissection is to understand there's like physical resource networks. These are the guys who put antennas on their rooftops for 5G or for weather data or whatever, or some sensors in their cars. And there's a digital resource network, which is, Filecoin and all the other guys where you just provide a server basically for compute, storage, and whatsoever. Well, then next question. Who knows what tokenomics are? Yeah, fair enough. So I'm working at 1KX. I'm a researcher, but my bread and butter is basically token designs and tokenomics. And yeah, as Vitalik put it, you don't really know what it is, and you should not talk about it. How I would define it, or what I typically talk about with protocols, is the economic design of your protocol. Because your protocol, yes, developers, right, they love the tech stack, they love the software, but if you think about the token economy, it has economy in it. So you should also think about that, because if you leave this out of the picture, typically your protocol is just software stack, right? So that's why I want to talk a little bit about that. Are there actually any economists in the audience? Okay, so you guys made better life choices than I did. Okay, so I don't want to go through all that, but the basic message is all about supply, demand, and balancing this. Sounds easy, but as you can see from the chart, looking through your protocol and who's doing what, that can get complicated. We don't have too much time, so I will not get into all of that. I want to talk about some core functions and how they relate, especially with respect to DPINs, right? These physical infrastructure networks, they have something special, and these are these roles. And yeah, let me quickly walk you through what this is. Because wherever you look at any DPIN, and the link in the bottom has some research where I skimmed through hundreds of DPINs to understand, okay, how can I abstract it? And this is kind of like the condensed version of like, okay, if I abstract it, any DPIN always needs these functions or roles, how I call them. And yeah, it's actually also quite obvious, as most economical stuff is. You have a user, and he needs, I don't know, mobile coverage. So he requests a service, give me a signal, I want that. Or he wants to store something, give me storage. So he requests work. Typically, he does so either directly with somebody who has storage, like Filecoin, right? He goes to the storage provider. He says like, yeah, I have free storage, be my guest. Sometimes there's some abstraction layer. It's the gateway. We first go to the gateway, think about Pocket for RPC request. You go to a gateway, and then the gateway distributes to whoever nodes on the backend can basically serve your request. Now, the tricky thing is these service nodes in the DPINs, they are decentralized, so anybody can do it. How can I trust the guy I gave my data that he really stored it? There's typically some sort of verification, and that function is the validator or watcher. And what they do is, they say like, yeah, it's all good, and they do some proofs or whatsoever. And what they do is they typically store that proof on the blockchain, which serves as your accounting layer, right? Where you also store all sorts of track records on the payments exchange, so on and so forth. So yeah, don't want to go too much into detail on that. Maybe as a takeaway, there are different roles in your protocol, and actually you can expand that beyond DPIN, but in the DPIN space, as we talk today, these are the main characters, these are the roles you need to think about. Now, the thing is, okay, I have a service I want to spell out, I have my protocol, how do I get these guys to do what I want? And what you do is basically you say, okay, come on, I give you some tokens for providing your storage supply because I have this great business model. And then with this provided storage, I will find customers. Eventually, they will pay. And with this payment, I can attract more supply guys, more storage. I can offer better services. And there goes my flywheel, right? Another cool thing in DPIN, it's quite simple. The flywheel is actually always the same. The roles are very similar. The flywheel is typically the same. Now, how do we do it? It's also quite similar.
When you think about reward emissions, these initial tokens that you need to give away, because initially there's no one paying for your service, so you give award tokens. And if you look across DePINs, I'm pretty sure you also find it like outside the DePIN sector, there's typically just 2 emission schedules that you can follow. The one is kind of like the Bitcoin classic on the left side from your side, just decaying over time. And I fix it over time, every whatever 4 years it's halvening, and then you get this. Arweave follows the same approach. A bunch of protocols follow this one. The right side is a little bit more sophisticated. It's KPI based, where you say, okay, it's not just time based. I have certain KPIs that I want to achieve. For example, Filecoin, they have these baseline, kind of like a capacity that they want to reach. And if the network has more capacity, if you have too much supply, then they actually cap the rewards accordingly. So this is more the KPI based. And as you can see from this example from LivePeer, the resulting token emission, this is the solid green line, looks a little bit less predictable as the time-based. And again, as I said, typically any DePIN that you find will follow in each of these categories. There's some small nuance in the sense of like, is it decaying or is it constant? Not going to want to go too much into detail here, because the cool thing I want to show you is, if you look at the data, another thing that's quite common across DePINs, they're very similar. Complex chart, let me briefly explain what it is. So on the x-axis is just time since inception, basically. And on the y-axis, it's the total the token supply that you emit as rewards compared to your total supply ever. So for Bitcoin, you would basically divide by 21 million, right? And for the other ones accordingly. And what you can see is, you look at all these DePINs, and they all do different stuff. They all have different models, but the reward emission is always quite similar. You start typically between, around 0.5% of a total supply until 1%, and then after 2 years, ideally, you slow down with emissions, which makes sense because eventually you also want to have some revenue that pays that, right? So we had the first piece of our economic design, which is just like, okay, the rewards, how do we structure them? Turns out, okay, just follow the example of everybody else, and there you go with your emission schedule. So this way you can incentivize the supply. Now, is this all that needs for the economic design for your protocol? As you guess, probably not. Because let's maybe look at Filecoin right now. Don't want to go through the whole P&L that's shown here, but what it shows at the bottom, not sure if you can see it, this is a big negative sign. And the issue is, with Filecoin, they are still paying a lot of token rewards, right? Each month, like over 20 million in token rewards that are emitted. And you can contrast that. I'm not sure if you see the line above. Maybe you can try this cool pointer thingy. No, doesn't really show. But what you see above the red circle is $13,000. This is what the miner actually gets. So you pay them 20 millions to run the server architecture, the storage, and all this. Like it's really big infrastructure that they run, and customers paying $13,000 a month. So obviously this is quite low compared to the effort you do. On the other hand, you also say, okay, is it the low income that's the issue, or is it the high cost? And basically both, right? Because when you think about your economic design, you as a designer can steer either or. So what I mean is, let's maybe look at the income side, right? I mean, we know it's low for DePIN sector. It's hyped. DePIN, everybody talks about DePIN, but if you look at the actual revenues, it's just over the whole sector, it's just a couple of millions. And the funky detail is, this is not even the revenue that goes to the actual miners, right? For example, some of this Filecoin revenue shown here, it's the miners paying that as some sort of penalty fee, and that counts as protocol revenue. But yeah, just as a side note, because what I want to allude to is, when you talk about the income side, how can you manage the income side? Well, income, the revenue of your protocol. And again, Econ 101, revenue is price times volume. And here we go again, like how do you set your price? You can choose. You can design it as you want because you're the head of your protocol. You can pick and choose. And guys, different protocols do it differently. For example, Helium, they say 0.1 cent, whatever, per gigabyte data volume that you do. Don't quote me. I don't know the exact number, but it's just a fixed price for service you use, right? On the other hand, you have Ethereum, where every block basically it's auctioned off. It's supermarket based. It's auction. The price every block is separate, right? You have a very market-based price finding mechanism that also changes each block. And then in between, you actually have some different approaches. Filecoin, for example, is somewhat market-based because you, as a user, you go to Filecoin and you can choose between different offers of different storage providers, what they offer as a price. And another piece is also that you can also change that. Pocket used to be a fixed price. They had it baked in their formula, how they charge. Now they switched to different models. Now they have gateway providers. And the gateway providers can basically tell you, okay, I charge you this price. And if you don't like it, you can go to the other gateway providers. So they went from the rather fixed price approach to a more market-based approach. Similar topic related to price. Typically, how DeepIn start is they charge a very low price. Not to say they charge nothing. Typically, you get to use them for free. And that's something you need to also keep in mind when you think about your economic design for your protocol. When you run a DeepIn, here, Pocket network, the green line is the demand, so to speak, the relays they served. You see, it looks like the typical DeepIn flywheel story of, oh, we kicked off the supply. The gray line are the number of nodes that serve the network. Kicked off, exponential growth, nice. The demand follows suit, also exponentially increases. This is the start of the flywheel, we're good. The only thing they forgot is utilization is not monetization. And in Q4 2023, they decided to basically say, okay, let's lower the amount of free tiers we give away. Let's actually charge a proper price for our service. And as you can see, then a lot of the users that were loyal users before just said, now I need to pay something, and I'm not using your service anymore. Other part of the income side and pricing logic, I don't want to go too much into that because it's a complex topic. It's afternoon. Again, just listing you that all these different design decisions that you can make is the pricing logic, but then you can also distribute who gets what. Again, Pocket is a network where they say, okay, the network used to charge you like a certain amount for the relay that you request. They switched now and says like, oh, you know what? We no longer want to be in the sales business. We don't want to sell stuff. We actually decentralized the sales teams. Selling happened at the gateway function. So they decentralized their gateways, and each gateway can now set a price, which is actually nice because you outsourced your sales stuff basically to anybody who wants to run a gateway. The only thing is, as a network, you're like, okay, how do you earn money then if you basically let anybody else collect the money? That's why they said no. For any gateway, for any relay that you serve, you need to pay like a certain fixed price, 85 cents per million requests or something like that. And this is this black line at the bottom, right? It's like the network needs to be paid. But what the gateway charges on top, this is totally their decision. They can set the price that they want. And again, this is just coming back to the price setting, is like you can define the price logic, you can define who is allowed to set the price, who not, and you can tie this to any other economic aspect that you want. With interest of time, let's also jump to the cost aspect, because I said earlier, right? These networks have, it doesn't look great because the income seems low, and the cost side, we don't even know, right? Because if you look around any protocol and you ask them, okay, what's the cost to operate Filecoin? What's the cost to operate Ethereum? Right? Like, I'm not sure if there's an answer to that. And we ask ourselves this question as well. And for example, did a framework for Pocket, which will also publish soon. So trust me on the numbers for now. You can challenge us once we publish this research piece. For example, Pocket is roughly $200,000 per month to basically run all the servers, to run the gateways, to also run the blockchain, the Pocket blockchain, to settle all these transactions, to pay all the roles that I mentioned earlier. This is the estimated cost. And why is this so interesting? I mean, this brings you back to like, I need to balance supply demand. I kind of like, first, yes, I need to incentivize people, but eventually, people need to pay enough that I can pay the bills, right? This is, again, Econ 101, and you kind of like need to do it with your protocol as well. The cool thing is you have so many different ways that you can do it and decide how you want to do it. You can change it over time. You have tons of degrees of freedom. Just a quick note on Pocket, because when you look at that, we saw that earlier that the nodes, the gray line went up tremendously. Obviously, that means if each node basically has similar cost base, your network cost goes up as well. And this is typically not good, because if you want to scale a business, your cost shouldn't go up with your supply, right? At one point, if you double your demand, your cost shouldn't double. And that actually also happened with Pocket. Initially, they had these bad unit economics, but then the node runners, they got chunked down the cost, had a bunch of initiatives, not going to go into that for now. But where they are right now is basically, okay, if they are where they are right now, they are at a stage where they can scale because they got the cost in place. Now, when they 5x their demand, basically, the costs don't grow as much. And then that's why they eventually become profitable. Not going to talk about the accounting layer because this is a whole nother level. Just a simple message, which I guess is easy to understand. LivePeer started on Ethereum and had Ethereum as their accounting layer. Obviously, in 2020, 2021, right, when the bull market was, there was a huge amount of cost for anybody who was operating LivePeer. So it was technically a huge cost to the network. It was like 100 ETH, I think, in a month or something like that. Arbitrum came along, so it was very natural for them to just say, like, hey, we know over 95% of our total cost base is we pay for Ethereum. Let's move to Arbitrum, and now the cost is like, I think, for sure less than 2 ETH a month or something like that. Because yeah, I wanna summarize because I know it was a lot, especially since there are no economists here. But the message is the economic design that you can define. It's all in your control. You need to think about supply, demand. How much can you charge your customers? How much do you need to pay your supply that they keep operating? And if this is imbalanced, you probably need to tackle either way, right? The first thing to do that is you define the roles. You need to understand, in my network, who is doing what. And also think about what do you centrally own right now versus what can you centralize along the way, because you can change the roles. The operating cost, I mentioned that as well. This is the one piece on your supply side. If you feel you're not getting enough income and somehow you can scale it up, look at your cost side, monitor them, understand them like, okay, how do I get them down? Because you really, whenever you launch a token, whenever the bull market, the price will be up, you have good runway, so to speak, to incentivize the supply, but you really want to incentivize a scalable supply side. Because if it's not scalable, the next bear market, basically, the supply side will just say, okay, you can't pay me anymore, I'm out of here. Yeah, the other things I talked about, define the pricing logic, also allow yourself to adjust reward emissions. I like it a lot when you kind of like keep yourself flexible because you never know what's happening on your product side, on the market side. So keeping flexible is good. And for sure, I think the main message is you don't need to do anything yourself, right? There's tons of other projects, tons of other protocols, tons of other builders. Just see what they already do, how we can integrate, how we can maybe outsource, collaborate, things like that. Yeah, and that's, I guess, my main message from this little economics lesson. I hope it was not too dry. And yeah, I guess we still have room for one question, two.
We have time for a few questions, actually. Okay. So yeah, thank you, Robert, for your amazing presentation, and we have time for maybe 3 or 4 questions. So yeah, thank you. Anyone? Yeah.
Hello, thank you for the presentation. I want to ask you, because I saw the slide of the Filecoin. So you see there is a huge discrepancy between what a customer pays and what they pay for the storage providers. And I know storage providers invested like hundreds of millions for the bare metal to run this. So what is their fix for this, in your opinion?
I mean, yeah, how they fix it, I mean, they need to figure it out. I mean, they're still well funded, right? Big ecosystem. I think they're already on a good traction to actually foster a lot on the demand side as well, because that used to be a problem, because Filecoin is a good example. They had a huge, basically, budget in the last bull run. There were months where this 20 million now in miner emissions used to be almost $1 billion in a month, dollar. For the storage provider. So for sure, the storage providers, they got a lot of money to operate. So even if it's less now, I would guess they got decently funded. But yeah, for them, I would say for sure they need to tackle more on the demand side, which they do, right? FEVM, integrations, ecosystem build out. But they also learned the lesson that, yeah, that takes time. But yeah, also the good side is they actually tackled costs as well. Like the ceiling costs used to be tremendously high. They cut it by 90%. But again, it feels to me like they need to speed up a little bit because, to your point, eventually, there's a lot of money, the operation costs. But yeah, that's why it's so important if you design a protocol, think a little bit upfront how you think things might play out.
One there.
So one of your takeaways was to allow yourself to be adaptable with the emission. I will worry that if I have to make, let's talk about Filecoin, I have to make the decision about providing storage for others. I would want to have some kind of predictability to make my decision. So something like this dramatically increases my risk because then I don't know anything about what will happen. So don't you think that affects very negatively the actual service provider for this infrastructure?
Yeah, and it's a good question and good point, because I think the wording is probably a little bit misleading. I'm not meaning that you want to be the protocol that says like, okay, I have 20% of my allocation for rewards, but how it's done, we throw a dice each week and see where it lands. It's really more about, in the early days, people follow a lot just blindly the Bitcoin model of like, yeah, halving over this amount of time. It's really super predictable, and this is how we go, which also means after 4 years, after 8 years, or after 12 years, eventually, the fiat value of these emissions will just dry out. And then either we made it or not, and that's it. So you want to probably a little bit be more flexible in that regard to say, hey, I know these guys have fiat costs. Maybe I should have a token reward model that gives them a base fiat model that they can plan for. If they can guarantee them, no matter what the token price does, you get $1,000 each month because I know your operation is $500, so you get this plus a profit, could be a good token model. Creates other problems down the line as well, right? But this is exactly the discussion or the thinking you need to have of like, okay, how can I think about it? Because yeah, if you don't think about it and just copy, some plain schedule because it looks good in a paper and feels like, oh, cool, math, sounds nice, then eventually you basically, you mustn't run into issues, but you steal yourself a big opportunity to, be more flexible and actually optimize your own degrees of freedom in your economic design.
I guess we have time for one more.
All right, thanks. This is great information. Really appreciate it. My question's about kind of growing the demand side. So for these networks like Arweave and Filecoin, right, that have existed and bootstrapped their supply side, and they have a Web2 competitor that's out there. how do you think about the unit economics of using something like an Arweave or Filecoin compared to a Web2 competitor?
Yeah, I need to be mindful of time, but there's two things to it. The one thing I would say is, for sure, there are more flexible in expanding their use case. I mean, the AO computer, for example, for Arweave, complete new use case will help fostering demand as well. The other thing is, typically decentralization is always seen as like disadvantage. But for example, if you look about the story of Uber and how Uber scaled so quickly, I think the guy recently also tweeted about it. They put, decentralized teams, super small, and these were their sales teams. And they would say, like, you go in this city, you go in this city, this city. So decentralization of your sales, similar to Pocket, is just another approach to just say, actually, I just want to have like more traffic on my side. Who's doing it? I give it lots of degrees of freedom I outsource it to other guys. But since I have this token to coordinate, I have this mechanism to coordinate, they can do it all over the world because my infrastructure is already integrated. There's another way. There's for sure more, but these two things all alone are something where I feel like this decentralization of sales teams, for example, as I call it, I haven't seen that so much yet. I haven't seen sales teams anyway in DeepIn so much. But this is for sure something where I feel like, okay, why actually not? For sure, I can see the way we're super early, so there are reasons why not. But I feel like we are at a time where we could explore this path and just follow the learnings from Web 2, because Web 3 seems even more destined to apply this.
Okay, I guess that's it. Thank you so much for your presentation again, Robert.
Yeah, thanks, guys.
And our next speaker is a very close contributor to the Gnosis DAO. And he's also the founder of Cross-Chain Alliance. Please give a round of applause to Georgios Gontikas. And he will be talking about scaling securely.
Thank you, Carolina.
Thank you so much.
All right. This is a little bit blocked here. Okay, hi everyone. The topic of my talk today is about scaling securely and showing how the need to put everything everywhere all at once. Let's start with the current state of the blockchain scalability landscape. We can call it scalability 1.0. It's what the industry has been focused the last couple of years. Both in vertical scalability and horizontal scalability. So horizontal is bridges connecting different L1s. Vertical is roll-ups, layer 2s, layer 3s. As we can see, it's basically scalability over everything. So the vast majority of bridges are secured by trusted third parties. And the vast majority of roll-ups, they have very, very strong trust assumptions still. However, the important part is that the pie has grown. Till last year, at some point, we have just a handful of roll-ups, and the modular paradigm was not even a thing. So it was just Ethereum as a DA layer, and today, we have like a very massive and exceedingly growing L2 ecosystem with dozens of roll-ups. We have at least 6 different data availability layers, roll-up as a service frameworks, and roll-up frameworks in general. And then we can see that with a TVL as a proxy, right, has grown multiples, which shows the user confidence has grown significantly. With this simplified diagram, so security over scalability, we've seen like that the biggest focus of the industry so far was just optimizing, making everything scalable, sacrificing essentially security. And now I'm going to go through a story how is basically our journey into building scalable products in Cross-Chain Alliance and in the Gnosis ecosystem. So we decided to take the completely opposite path. So we tried to prioritize security first. Obviously, in the beginning, kind of sacrificing scalability. And yeah, we define a couple of values, like a couple of design principles, how we want to build our products, like what is going to guide our decisions, design decisions when building products. And these are, yeah, 3 simple things: security first, security in depth, future-proofness, and no vendor lock-ins, like minimizing dependencies. First up was ZK-Lite clients, right? How we've been operating ZK-Lite clients for interoperability, like securing yeah, connection of 2 ecosystems. And yeah, it's an amazing tech, right? It's a trustless and super cutting edge, but it has a couple of disadvantages that not many I mean, it's not up at the surface. Right? Not many people have seen, especially if not operating them actively. So what we've seen is, first of all, it's quite expensive to run multiple ones. And since one of our kind of design principles was future-proofness and security in depth, we wanted always to run multiple ones, and that gets very expensive very fast. They are slow, obviously, a lot slower than you know, a trusted federation of validators. There are still trust assumptions, actually, so most of the implementation of the ZK-Lite clients rely on the so-called sync committee and not proving the full consensus. And the most important part is that there are liveness concerns. So although these systems are kind of trustless, there are specific, or let's say trust minimized, there are specific centralized components that if they go down, for whatever reason, your whole system goes down. So then we went on and built a couple of products to solve this initial issue. So the most important one being Hashi, which is using multiple sources of truth in a kind of multi-sig of bridges way to secure a connection between the blockchains. Then PanDA, which is a very similar, like a product based on the same principles, connecting data availability layers. Cross-chain Safe, which is using these super secure rails to secure connections of smart accounts across blockchains. And Fragola, which is a lending-focused protocol as a kind of Aave specific to facilitate the secure cross-chain lending of the Go stablecoin. Then, yeah, we realized while operating them again, especially Hashi, that it's super secure and future-proof, but it's quite expensive, right? So we're trying to find ways, how do we improve performance, but without compromising security at all? What's the key here? Proofs. So proof, don't think immediately zero-knowledge proofs. So yeah, zero-knowledge are also proofs, but yeah, we can define proofs something more general as, I like to think of them as, you know, verifiable facts, or as we write here, portable verification of statements, right? And these systems can help in a couple of domains. The horizontal scalability, the bridges, that was our main focus. Vertical scalability, obviously, as an example, ZK rollups, right, are based on proofs. But also any kind of generic off-chain computation or off-chain data like oracles or coprocessors, as is the a name that is being used lately. So yeah, we've seen that the industry is actually going towards this direction slowly. So from the scalability 1.0 paradigm that we mentioned in the beginning, the scalability 2.0, which is trust minimized, right? Fault-proof based optimistic rollups, or ZK-proof based layer 2s, or multi-proof based bridges such as the Hashi one we mentioned. And also similar trusted solutions for the data availability layers. How do we go from 1.0 to 2.0 is this proof layer. So conceptually, it's a proof layer. What does it consist of? Proving infrastructure, ZK-VMs, a coprocessor, and most importantly, aggregation, which is a very powerful feature of proofs where you can basically maximize the cost reductions. However, while working with these systems, we realized that this is not the end game yet. There are a couple of challenges that still need to be tackled, mainly in three categories. First of all, proof production. How do you produce this proof? These proofs. Currently, all the systems are, or most of the systems are super early stage, evolving rapidly, and are very inefficient. Then the verification part, like because proofs are produced off-chain, and then without verifying them on-chain, they are basically useless. You don't even need a blockchain, so you need to verify them somewhere. And then you come up, since the demand of this is growing, you come with the same problems of gas spikes or capacity limits, right? So we all know the capacity limitation of Ethereum, for example, as a layer 1 for verification. And last but not least, the architecture, so the whole implementation of the system is by itself a big new attack surface because it's super complex, it's very difficult to audit. The teams that are actually implementing them are very few and written in different languages, like CIRCOM and similar stuff that is not like Solidity, for example, that is common, like well used and known in the blockchain ecosystem. As an example, here is the rise of the zkVMs, right? So there are at least three teams that have announced zkVMs in the last couple of months, and they made announcements, I believe, with a couple of weeks between each other. One was 2 times faster than the previous one, then another one came with an announcement a couple of weeks later. It's X times cheaper, 20 times faster. So, and then we as users of the system, as developers, we faced with a couple of questions and concerns, right? Like, how can I basically use them? Which one should I choose? Can I basically switch from one to the other? What's the locking I'm getting into using one of the systems? So yeah, I mean, the main conclusion here is that we realized trying to build with these systems that there's still kind of a missing piece in this puzzle to achieve like, yeah, I mean, I didn't put the piece like completely top right, that would be a bit illusional, so we just need to find the right balance between secure and scalable infrastructure. To achieve that, there's basically 3 key ingredients, 3 key points that we need. First of all is a developer experience first, right? So this is focused for developers, so we need SDKs that can support multiple proving backends and allow developers to develop security in-depth systems. Then we need some sort of an engine which will mainly aggregate all these kind of proofs to get all these cost benefits we mentioned and index them, right? And most importantly, we want to provide a kind of a really good developer experience in the form of a database-like interface, right? So you don't need, as a developer, to deal with any of this, low-level proof stuff. You just need to query for specific facts, verified facts that you need, and get the answer for that. And a key part of this that it needs to be fully chain agnostic, right? Live in a multi-chain world. Here, this is how conceptually this would look like. So on the left side, I believe for you is also left, yeah, we have the off-chain proving universe, which includes most of the stuff we just mentioned. So like all these zkVMs that are around, or also Mina or the Neil Foundation, or technologies that are, let's say, not that new, like TEE, that already kind of more battle-tested. Aggregation, ZK aggregation protocols, ZK coprocessors, even fully homomorphic encryption, anything that is basically off-chain, verifiable off-chain computation. And then you have the on-chain settlement universe that is, yeah, you can like a verification layer such as Ethereum, but here we see the need that this should be a set of chains. So it needs to be chain agnostic. It needs to be available everywhere. And yeah, in the box, in the green box is the applications, the protocols that would use that. On a high level, who would use that, right? It would be applications that need some sort of access to some sort of cross-chain state, such as cross-chain interoperability, right? Or in the more general case, offloading a very expensive computation off-chain, but having verifiable results on-chain. And another obvious use case, obviously, is privacy, right? So you can run code that is not publicly visible on-chain. You have a proof. You verify it and use the results, the outputs on-chain. Yeah, here's some more specific use cases to make this more concrete, what this cross-chain state could be, right? So execution proofs from layer 2s, right? That something has happened on a specific L2, or stuff that we use already for interoperability, like proof of consensus. This is what most of the ZK Lite clients are based right now. Or storage or event proofs, like that something, like a fact, a verified fact, that something specifically has happened on a specific chain. And you just need this result. Then, yeah, the coprocessors, like any kind of generalized computation. And another interesting example here is the trending topic of risk-taking. So the eigenlayer AVS is so reusing Ethereum's security to secure your own applications and protocols. And these come in sort of commitments that can be also provable, like verified facts fit into the system. So yeah, to summarize, the end game, we believe, of this proof centric future is proving everything. So like any kind of proof type, any kind of system that needs to offload off-chain computation everywhere, like chain agnosticism needs to be available on any chain. You should not pick specific chains, and all at once, like aggregating everything and basically minimizing the cost and maximizing the efficiency of your system. And yeah, that's it. Thank you.
We do have time for a few questions. So, does anyone have any questions? No? Last opportunity here. Okay, then let's just make a quick break, and we'll be back in 5 minutes. Thank you so much.
Cool, thank you.
Please give a round of applause again to Georges. And
thanks. Hey.
Can we go? Yeah. Yeah, and right next, please let's welcome Lucas Vogelsang. I hope it's well said, and Stefan George. Lucas is the CEO and co-founder of Centrifuge, and Stefan is the CTO and co-founder of Gnosis. Together they will be talking about how can we bring DeFi to the real world. Please give a round of applause to them.
Thank you, Carolina. Hey, thanks. Yeah, thank you all for joining. Today we'll discuss real-world assets. For us, for Gnosis, that's actually a very important part where we see a lot of growth potential. And with me today, as Carolina already announced, is Lucas Vogelsang. I would say an OG in the field of real-world assets. I think Centrifuge started 2017?
2017.
So I think there are very few companies that actually last in crypto that long. And I think that allows you to also have a different perspective, I think, on real-world assets and how the landscape has evolved. I think if we exclude, let's say, the core stable coins like USDC and USDT from real-world assets, then I think if you just look at the market cap of real-world assets, still fairly small compared to the overall market cap.
Yeah, it depends on how strictly you define real-world assets, but it's about $1 billion today.
So in short, it's basically
nothing.
Nothing.
In the traditional markets, asset market sizes are measured in the trillions. So yes, we're 3 orders of magnitude lower still than that.
Yeah, so there's a lot of growth potential. I wonder, how do you see, how has this topic evolved over the time, as you have been starting, almost a decade ago? And what has changed, and why do you think right now we are at a point where we can trigger actually this growth phase?
I mean, I think, and I think we really should have a conversation because, of projects that have been around in this industry for so long, I would count also Gnosis as one of the few that is surviving and thriving. And I think we actually have probably very different journeys, but are working towards ultimately what I think is a very similar or shared vision. We maybe I think very typical of 2017 crypto founders was you come into the space with a bunch of naivety and a bunch of kind of big dreams, and then you spend a couple of years realizing you need to build a lot of the fundamental infrastructure that's missing, right? I mean, Gnosis at the time was trying to build a prediction market, and you ended up building a DEX, a wallet, a multi-sig, a chain, bridging, and a credit card, debit card. So I think similar for Centrifuge, we had this big vision. I kind of knew about Bitcoin for a long time before I really believed that Bitcoin could go anywhere. My challenge with Bitcoin was it's too exotic for a real user to kind of start buying their daily groceries in it, or for a person in finance to actually use it. I loved the censorship resistance. For me personally, motivation was always the story of WikiLeaks getting deplatformed, Visa and MasterCard just turning off any sponsorship of or people donating to WikiLeaks, right? And so that was the idea that you could use Bitcoin for something like that was great. But from there to what is actually a product that everyone in this world will want to use and can use, I think is quite far. So with programmable money, which was one of the core ideas of Ethereum, I would say, and to date still the most popular use case of programmable blockchains. That was when we said, oh, this is actually what we can use to allow businesses, banks, financial institutions, borrowers, lenders, right, from around the world to come and actually do these transactions without as many intermediaries as was necessary in the past, doing it in a much more open way, kind of building this financial system from scratch. What we, at the time, we didn't have stable coins, we didn't have any significant kind of on-chain liquidity. Most people that were using DeFi didn't really have an understanding of how these financial products worked. and so it was that was kind of the long journey we took to today. And I think you can kind of look at what were some of the big stepping stones and or kind of like achievements we've had. I do think the proliferation of stablecoins as like a stable medium and store of value is very important. Fiat on off-ramps becoming a lot better. I think we're not there yet on regulation completely, but I think there's a much better understanding. And I think in some way also, like fast forward to today, I think people, like now in 2017, I thought, yeah, like we just need to build some smart contracts and that's what's going to replace the financial system. I think what I learned, or like what we as an industry learned, like there's a lot of stuff in finance that we have to like actually bring in, like knowledge, people, etc. And I think the people part is a really important one, because we did see, I think about 3 years ago, the average person that came from a finance background and was interested in crypto was interested because Bitcoin is crazy volatile, because it's digital gold, it's an asset class that they can invest in. Today, the person that has a finance background, like whether that's working at a bank, in credit, in lending, in equities, really anything, right? They are starting to understand, actually, it's not an asset class. It's a technology that I can use to do my work in a better way, in a more efficient way. And I think that is like maybe the reason why we saw even like the largest banks, right, largest financial institutions go from having almost no view on crypto or a very limited view on crypto to like BlackRock launching a tokenized fund, to like everyone starting to buy these products in ETFs. And so I think that is like that was like what gave this a lot of boost. And this is we're just seeing the beginning, right? I think over the next years, you will see like a massive inflow of like new assets, and ultimately like new buyers of these assets that will be comfortable actually using this technology because they see this is worthwhile to make the investment in to start using. Which maybe, I mean, to turn it around to Gnosis, as I mentioned, you started with the wallet.
One question.
Yeah.
Do you think then the adoption will come mostly from institutional side or retail side?
I think this is where I mentioned we have maybe a bit of a different path towards it. We've focused very much on the institutional side because I do think like crypto is very hard to use as an individual. In kind of creating tokenized products, whether that's treasury bills or credit, like then going and selling those to retail users is very hard. So actually what we said is, well, instead of trying to go and try to get the average person to invest in a real-world asset, it's much better if we go to DAOs, because they, like a stablecoin, it should be a stablecoin collateral, right? The first thing we did was we worked with Maker to onboard these assets to mint DAI with it. Why? Because like I think those are kind of the financial institutions of the future that can do the work that is required to underwrite and evaluate what kind of real-world assets they want to buy, kind of go through this work and then make this decision. And so for us, like it was this almost like B2B2C kind of distribution strategy where like I don't think Centrifuge today is at a point where I would expect hundreds of thousands of users to own these assets in directly, the same way that I personally don't try to pick stocks. I bought Apple stock because I thought, yeah, it's probably a good idea 10 years ago, and it was a good idea, but like I don't do this on a regular basis. There's some people that do, and like Robinhood, for example, is a good example of where people do it, but I think we've started with the institutional users. I think then you'll see things like ETFs and like broad funds, kind of high yield savings accounts, like those products that still need to be built, that then I think are more retail friendly. But you did take kind of a different route, right?
Right, yeah. So for Gnosis, of course, we are operating a network, Gnosis Chain. You're also operating actually a network. Centrifuge actually is also its own blockchain. But for us, our vision is to actually bring crypto to a lot more users and make crypto more accessible. The core of the strategy is a wallet that we're implementing called Metri. For those of you who have not tried it, you can onboard to Metri to buy ice cream. It's very delicious. And
down there, ground floor.
Yeah, if you haven't done it yet. And this is a wallet that is really optimized for great user experience. It uses new technology like passkeys that can be enabled through safe modules to allow like really straightforward key management. And with this wallet, we really try to address the Homer Simpsons of this world to really make crypto so accessible that anyone can actually start using it. And for this, we are building different bridges to real-world finance. So Gnosis Pay is core of the strategy, where we integrate with Visa and allow people to offboard easily. We also have other integrations with Monerium to the SEPA network. So we're basically trying to build an experience that for the end user should be indistinguishable from a neobank-like experience. And we really see that in order to offer more services, real-world assets will be a very core, important part that our user group potentially would like to have exposure to. And this is right now not possible. I think if today, let's say, there would be liquid assets for all kind of different stocks and ETFs on chain, people would start using it just to diversify, for example. But right now, the problem is it's kind of a chicken-egg problem. As you said, the total market cap of all real-world assets combined is just $1 billion. And then for every specific product, it's so small that as a user, you see a risk that you are you have risk in holding this token simply because there's very few intermediaries that control this. They have not been around necessarily for a long time. And there's generally worry. I mean, I personally try to convince parties that are very close to me to diversify into real-world assets via different protocols. And there was always the argument, it is something that is very new. We don't know how long it will be around. And how trustworthy is it? Even if there's a close relationship, there's still hesitation. And in that sense, it's kind of a chicken-egg problem where first trust has to grow in order to issue more assets, and then it is, then it also becomes more attractive for others to join, of course.
I mean, this was one of the hardest thing for us, was to kind of bootstrap and like in 2020 when we did the first pilots in 2019, but in 2020 when we first had the first kind of broader, like bigger pools go live, and bigger at the time meant for us like more than $1 million. So it was extremely hard, and the challenge on the flip side is what you mentioned, chicken and egg. You kind of today still operating at a stage with relatively immature technology at a scale that is still a bit too small to really make this work. So you kind of you struggle in, well, you don't want to underperform TradFi assets, because then you might as well just go off chain and do it the traditional way. But to really outperform it, you do need the demand. And so like, okay, where do you get this demand from? I think we've gone from, I mean, at the time, I think in 21, we had 8, so we went from like 10 million TVL in 2020 to 80 million in 21. Then, like, of course, FTX and Luna wiped out a lot of TVL, so we actually stayed kind of constant. Now we're at around 270 million. The single the single deals, they started growing, and so we're like, again, I mentioned like in TradFi, those deals are like no one really does anything under $100 million. Or very few people do. So like this is still extremely small, but we're getting to a point where now you do have like the number of stablecoin holders go up, and now there's a number of those people are realizing, okay, maybe I do want to start earning some yield. The interest rate environment in the off-chain world changed as well, which means actually, I mean, this was another challenge for the longest time. Like you almost never beat DeFi yields, like whether that's like supplying into Aave or anything else, if you just bought treasury bills, because those rates were 0, and in DeFi it was always a bit higher. Now it's a bit more balanced. It's still like in the bull market, DeFi yields go up like crazy. In the bear market, they go down. So that depending on where you are, I think that is like actually changing, and that is creating a lot more organic demand actually. And I think that, so we are getting to a point where now we can start onboarding bigger users, but like these users, right? Those like asset managers, like they would launch an ETF-like product on chain. Now they So now it's you can start talking to them. Well, they'll probably take a year to make that decision, to vet everything, to go live, right? But that is eventually going to happen. So for us, it really has been like to kind of go from one kind of equilibrium of like supply and demand, which was like 10 million in 2020, to like scaling to 100, to like now like trying to see, okay, how far can we scale this next? And so yeah, I think this kind of supply demand is still quite challenging, and crypto as a whole is still very isolated. So like the Gnosis Pay, and the more I think is extremely exciting, because the more people that go in and out of crypto all the time, and the less it becomes this isolated, crazy speculative, volatile asset class ecosystem that is like DeFi utility tokens, governance tokens, maybe staked ETH, meme coins, NFTs, right? And being completely in a separate world, and like your real estate portfolio, the account you pay your monthly rent out of, and everything else, right? We need to bridge those worlds together, both on the individual user, but also on the B2B side, because that's like when we'll start to actually make those markets be more efficient, and test a lot of those like kind of overlapping area that ultimately for us is real world assets.
Yeah, I can totally see that, especially kind of what you mentioned is kind of in some sense funny that in order for real world assets to become more attractive, our market has to go more into probably like a more stable or almost bear market-like environment, where there's a higher incentive to diversify, and also, potentially invest into bonds. I know there was very high demand to get like US Treasury bills on chain for some time, and then of course, as soon as the yields went up in DeFi again, then it's of course it's much more attractive to just get exposure to those.
I mean, the interesting thing is like, and not to nerd out in finance too much, but like the risk, what is considered like risk-free, I don't know, like the DAI savings rate, or like the Ethena SUSD yield isn't completely risk-free, but like you can say it's hedged against the market. You take some risk against some of these exchanges, but like that, like Ethena's product exists in the TradFi world as well. It would be just called a basis trade hedge fund. That is a few basis points above treasury bill rate in TradFi, whereas in crypto, it's 20, 30, 40, whatever percent, right? The reason for that is there's ultimately just one primary reason, because when you do this basis trade against corn futures or oil commodities or whatever, right, there's hundreds of financial institutions that will very happily lend almost unlimited amount of money to it and make this extra 10 basis points, because the risk is well understood, there's good regulation around it, and so it's pretty easy. Whereas in DeFi, all of these derivative exchanges, or almost all, don't actually accept US counterparties. So all of Wall Street is already like kind of shut out. Wall Street would never do it anyway, because like as long as you have FTX and Mt. Gox happening on a regular basis, meaning like more than every like 50 years, which is maybe the last larger financial crisis, or maybe 20 years, right? Then that risk is way too high for like actual traditional financial institutions to come in, which does lead to, like today, those two markets are very, very disconnected, and so which is why ultimately like DeFi yields go like crazy when there's like positive market sentiment, and like all like kind of TradFi isn't able to or doesn't want to tap into it.
Yeah. Kind of ending the time, but what kind of real world assets do you think will, like, what is the asset that people would be most excited about? Like, if Centrifuge I would have to double down on one thing, what do you think would be the real world asset that would have the most demand?
I would give two answers. I think maybe the people in this room, the people that are in crypto today, they probably want relatively liquid, still slightly higher than treasury bills, yielding assets that are relatively simple. So like, it's really maybe like a place where you park money for a couple of months. I think like there's kind of that can be in very high quality, investing in very high quality loans, like a distributed portfolio. I think that's kind of the need of this like on-chain high yield savings account, a replacement for SDAI or putting money into like an Aave market, for example. Now, if you talk to someone in TradFi, they want something they can't get today. And so there actually, my answer would be, you have projects, one example I always use is like you have projects tokenizing music royalties. What if you actually then could take those music royalties and lend against them and earn interest? Now that is a market that is extremely like fragmented in the traditional world, like very liquid, very intransparent. So like most investors can't really easily invest in that at scale. So if you go to a traditional investor, like you'll have to sell them on something like, yeah, like you can invest in these assets through crypto because they're actually crypto. They have some easy way to get into these assets that they don't have in the traditional world. So, and I think we're trying to kind of do both in Centrifuge.
Cool, very cool. With this, I would like to open it up to the audience in case anyone has questions.
Thank you so much, both. Amazing conversation here. And yeah, we have time for a few questions. So please, whoever wants to make any questions.
Wait just a second.
Oh, thank you. That's nice. Lucas, you mentioned risk as a major obstacle for TradFi investors to get in. To which extent do you think regulation and infrastructure is also an obstacle at this point? Is it less so than before?
I mean, I think for me, like regulatory risk and technical risk are a huge part of the risk that I'm talking about. So no, I think that is part of it, right? Like as a large bank, what happens if you hold USDC and there's suddenly like a bank run and like your shareholders freak out, right? Like that is very hard as opposed to like having a well-regulated stable coin that like you can treat as cash and like you're on the safe side. I think another one for sure is like wallet infrastructure, like you talked about passkey and like just a very easy way to onboard. Institutional users, they need to use the same, right? Like the idea that you're paying like thousands of dollars a month simply to hold like a digital asset in a relatively secure custodial way, I think is not really realistic, and we need things like SAFE to be much more established. And like, I mean, it's like I sometimes sweat when I make large crypto transactions, and I do it often. Like that is, now imagine someone that hasn't been doing this for 5 years, 6 years. Like that is like that is like obviously very expensive, right, for them to kind of justify that risk. Yeah.
Anyone else?
And I think SAFE is awesome in that regard. Like this is where it's going to go.
Yeah, I think technology-wise, we are getting there.
Yeah, solving a lot of this.
I'm not too concerned about technology. I think regulatory-wise, that's still
a bit
difficult.
less under our control, but
we
can
can also say from Gnosis DAO perspective, for example, we actually, I think we're the first DAO to onboard to Centrifuge, right? Or one of the first, and we also acquired like real-world assets from other providers. But until now, we did not really feel comfortable, and we as like a larger like organization or like larger teams providing liquidity for those assets on decentralized exchanges. And that's of course what needs to happen eventually, like give other people exposure to it and be able to distribute those assets easily, right? And right now it's still like a very convoluted process. It's really like, I think I'm one of the few people who holds actually Coinbase stock on chain. And I'm very happy that I did it, but the process is just so complicated and it's just nothing in any way scalable. But I'm pretty sure if we can prove that there's enough demand and issue enough of those assets on chain, I think then there's also just the incentive so high that people will start providing liquidity and make it more accessible. So I'm just talking about this chicken and egg problem. Recently, I also had a discussion with another real-world asset team about this. How could we possibly solve this? And it would be maybe one way to kind of there has to be like a way to gauge interest, which also sort of is a pre-commitment to actually invest into those, almost like a Kickstarter campaign. Like if you have enough people willing to buy this asset, then actually it is fulfilled. But yeah, I think we'll see.
I think the DAOs, right, like Gnosis DAO, or like having like a way for example Gnosis Pay users to just very simply go in and out of these assets, but then like not asking them to like make their own investment decisions, but like using a DAO to kind of curate a different portfolio option so that I can at least know I pick between these five different asset classes, right? As opposed to like saying, okay, like I like IBM and you like Sony, and like we're gonna have to do all of our homework ourselves. I think simplifying that process is going to be very helpful.
I think we have one extra question. Yep.
Yeah. So Piers from Radix. There seems to be a trend at the moment in DeFi towards yield-bearing tokens, where you essentially abstract away the underlying, and then you have a yield-bearing token on top of it. You've seen that popularized on platforms like Blast, Mountain Protocol, etc. Do you think that this is the direction of play for real-world assets on Ledger, or do you think that that isn't the right direction?
I mean, yield-bearing tokens, every kind of credit product, I would say, will end up being some sort of yield-bearing token. An equity product typically maybe will have a dividend but not bear yield, right? Like Coinbase is just whatever the price of Coinbase is. But like treasury bills, like credit, etc., all of these, I think, will ultimately be tokens that will just expose you to yield. I think the one big question that that comes up though with like Mountain and some of these others is like, how safe is the asset actually? Technically creating a yield-bearing token is easy. Legally, you have, and this is maybe also a challenge of how early we are in the industry, it's very, very hard, there's maybe like 100 different legal structures today, and it's very hard to know which one is the right one. And it'll still take a few years for have like some legal structures crystallize, right? Like we know the entire reinsurance industry is in Bermuda, like because they have a good legal structure. Every company that is almost every company that's incorporated in the US actually uses the Delaware legal system because they're very friendly, like they have a good legal system that makes sense to incorporate a company, right? And so I think similarly, like there's in real world assets today, there's people experiment with Switzerland, Luxembourg, Bermuda, Cayman, BVI, US, right? All of these things. Now that I think is still like then there's some that just say, oh, we don't need any of this. We're just going to do it all permissionlessly and hope that no one will sue us. So there's these kind of different approaches, and I think we'll like have to go through a lot of like learning, and some of this learning will also be painful because it will be like losses and lawsuits that will decide some of these things. But that's maybe like the key point in like where these where it actually is the difference in these different yield-bearing tokens.
Not sure if you want to add something, Stefan, or
it's all good. Yeah.
We still have 1 minute, so maybe one more question. Okay, then I guess that's it. Thank you so much again for the amazing conversation.
Thank you.
Thank you.
And yeah, Lucas and Stefan will be around anyway, so if you want to make any questions to them, feel free to. And now we will have a 30 minutes break. So please, thank you so much for being here in the afternoon sessions, and we'll see each other again in 30 minutes. Thank you. Hello, everyone, again. Thank you for waiting. And in our next talk, we'll be welcoming Brian Crane from Chorus One, and he will be talking about the efficiency between proof of stake versus proof of work, right? Yeah, and some other things too. So please give a round of applause to Brian, and yeah.
Thanks so much. Yeah, thank you, everyone. I'm really happy to be here. It's my first time back in Berlin after like 3 years when I moved away from here. So yeah, and excited to talk today about the staking economy and proof of stake. So just a bit about myself. So I've been in crypto since 2013. I actually got into crypto right when I moved to Berlin, and I started the Bitcoin meetup here in 2013. And then I was at Tendermint in 2017, so I was COO at Tendermint. So Tendermint was the company that started kind of the Cosmos ecosystem, and was one of the first modern proof of stake network. So I was there kind of at the inception of proof of stake. And it was already very clear that the future was proof of stake. Ethereum was working on proof of stake. Polkadot, all these other networks were also already working on proof of stake. So I wanted to start a company focusing on infrastructure for proof of stake. So I started that around 6.5 years ago. Yeah, I mean, aside from Chorus One, I'm also at the Interchain Foundation. So that's the Cosmos Foundation, on the board there, and have been running the Epicenter, which is at this point the oldest crypto podcast. So proof of stake. So proof of stake is basically a mechanism that is used to achieve agreement in a network about what is the valid state of the network, and to validate all the transactions and make sure that transactions are processed and the chain is secure. And for that you rely on validators, who have this role of proposing and validating new blocks. And I was wondering, is it possible to move this timer somewhere else or turn it, because it's hard to actually, thank you. And then, the validators are basically chosen based on how much assets they have locked as collateral. And of course, that gives this level of economic security. So just a little bit maybe about Chorus One, a few things. So as I mentioned, we started around 6.5 years ago. And today we secure around 50 different blockchains and have around $3.5 billion staked with us. And we around 65 or 70 people, and primarily focus on staking, but there are a few other things. So we also do a lot of venture investing in kind of new projects coming up. We have a big research focus, so we publish a lot of research. A lot of it is around new protocols, but also around research related to proof of stake and kind of like the new things that are coming up there. And we've put a lot of work into Opus, which is our Ethereum staking product. So I just want to zoom out a little bit and talk a bit about proof of work versus proof of stake. So if we look today, right, then if you look at the entire crypto market cap, it's still basically there's about half of the crypto market cap is proof of work, but that's basically all Bitcoin. And then the rest of the crypto market cap is practically all proof of stake or assets that are actually issued on proof of stake chains. So if you look at the top 10, something like 8 of them are proof of stake assets. And then there are things like USDT, USDC, which today also primarily are issued on proof of stake chains. So we already have that basically proof of stake really secure almost the entire crypto market cap outside of Bitcoin. And of course, even roll-ups and stuff like that, well, indirectly, they're still, since they're relying on the security of the underlying proof of stake network, at least once they have fraud proofs and all of that stuff, still reliant basically on proof of stake. So it's really become this fundamental thing of how we secure blockchains. And why is that? There's different reasons, right? But definitely one of the big reasons is that there's this huge efficiency advantage, right? So Bitcoin pays around 11 billion to miners every year. And in proof of stake, the entire proof of stake rewards every year are around 13 billion. So on the surface, it looks like, wow, that's actually more, right, than for proof of work. But it's kind of deceptive, right? Because in Bitcoin, all of the rewards and all of the mining rewards, they go to the miners, and the miners spend it on hardware, and they spend it on electricity. But in proof of stake, it's different, right? Most of the rewards, they go back to the token holders who already hold that asset. So it's not really a cost to the token holders. And the cost is really just what is paid in commission to the validators. And let's say we take something like 5% on average, that means all of the proof of stake networks together maybe spend something like $600 million a year, for operating all this infrastructure. And so if you just take this efficiency comparison here, it means basically in terms of, how much is being paid to secure an equivalent amount of economic value, then proof of stake is around 8.5 times more efficient than proof of work. This was actually twice as much just very recently before the Bitcoin halving. But yeah, in addition to that, right, maybe a different point, you can argue that the security of proof of stake, yeah, you can also think about, what has the higher level of security. I think from a game theoretic perspective, it's also the case that proof of stake has, it's more expensive, more difficult to attack a proof of stake network. Now, in terms of, the type of customers that engage in proof of stake, it's actually a huge range. Again, there's a big difference from proof of work. Proof of work, it's a bunch of miners, which is its own secluded industry. But in proof of stake, because it allows any token holders to engage with it, we really have a huge range of different entities that engage with staking. So that's individual, retail investors, it's foundations, it's the core teams, and it's all kinds of different institutions as well. And now, if you look a little bit at this staking economy, we dive a little bit in here. So, the total staked value today is around 260 billion. And out of that, around 18%, 19% is being staked through liquid staking protocols. So liquid staking protocols, basically, they allow you to, pool the asset, and then it gets staked from that smart contract. That's especially popular on Ethereum, and it's not super big on other chains. And now if you look at the staking rewards, like how do the staking rewards break down? The vast majority of rewards, they come from coins that are new coins that are being issued with every block. So that's, almost 3/4 of it. But, there are some other things, that we have gas fees, basically when people pay transaction fees, and MEV. Now, the gas fees and MEV are also very Ethereum heavy, right? Like most of the other chains, they have pretty minimal, still very small economic activity. And so it's really inflation on most of the chains. But there are some exception here. For example, if you look at this 100 million mark here and other, I think a lot of that is DYDX. And in DYDX, it's basically on-chain decentralized exchange, and the trading fees, they get paid to the people staking. So, and this is around 100 million a year. So it's actually very impressive that you have a chain that's entirely secured through the fees that people pay from using the chain, and they don't have any inflation on the DYDX chain. So there definitely are some other protocols, and I think in the future, of course, we would expect this pie chart to change a lot, right? I think the inflation bit is going to go down, and it's going to go down hopefully because these other things go up, but also because the protocols generally have some kind of schedule where inflation decreases, as time goes on. Now, when you look at like proof of stake, you also see there's a lot of different proof of stake designs. And probably the biggest sort of two categories of proof of stake design is, Ethereum on the one hand, and on Ethereum we basically, we don't have in-protocol delegation, right? And basically each validator has the 32 ETH, and there can be unlimited number of validators. So that's kind of the Ethereum design. But most of the blockchains, they have a different design, right? Most of the blockchains have in-protocol delegations, and they have a limited validator set. So I think sort of the paramount example here is like Cosmos, for example. So let's say you have a maximum of 100 or 200 validators. It's something that each chain can decide. And then anyone can create a validator, and the ones that actually do the work, the ones that are actually active, are the ones you basically list all of them by how much they have staked with them, and then the 100 largest ones, for example, are in the active set. And then, maybe one of them has like 5% of the voting power, and another one has like 0.1% of the voting power, and then the one has 5%, will produce 50 times as many blocks. So this is like really easy, really convenient. It works really well. And this is something that basically most of the chains have adopted a model like that. So that's, Solana, Aptos, Sui, Cosmos, but, there will be many others that can be named here. And then, there's a few that have chosen sort of an Ethereum model, and then there are others that have, some kind of hybrid in between. In general, I think it's a good question of like, did the Ethereum stake design make sense? I don't, it's a questionable thing, I would say. It definitely has created a huge amount of need to create like other things on top, like smart contract systems and stuff like that. And yeah. So in terms of the different products, right, that people need to sort of for their staking, it also varies a lot, right? So we have the delegation thing, which is sort of the standard thing that I just mentioned, right? You just make a transaction, you stake with the validator. Generally, all the logic is handled on-chain. So the rewards are distributed on-chain. The validator can set the commission rate. It automatically gets deducted on-chain, and it works really well. It's not always like that. Some of them have, for example, that rewards aren't managed on-chain, like Tezos, or there are some exceptions. But generally, it works like that, and it works pretty well. But there's some other types of products. So, for example, we do like white label validators where there will be some party, they want to run a validator with their own brand, their own maybe commission rates and stuff like that. And then we can kind of run the infrastructure for them. But it's sort of, it's kind of like a validator as a service type product. And then, we have liquid staking. Liquid staking is also something, again, it's primarily something that has traction today on Ethereum. And I think it has traction primarily on Ethereum for that previous reasons, that there's no in-protocol delegation, and there's basically a bunch of constraints that Ethereum has imposed that make the sort of normal staking experience pretty inconvenient. And that's why I think liquid staking has a lot of traction there, but it's also something that's gaining traction in other networks. And it's also something that, we, for example, do today for customers using, for example, a protocol called Stakewise, which is very elegant. And then, of course, you have other things like API products that easily allow customers to integrate staking offerings into their product. So, that can be like wallets or custodial products or like exchanges, things like that, where they have customers who are holding asset on their chain and they want to offer staking to them, and they want to outsource kind of the work of actually running the infrastructure to a third party. Yeah, so this is kind of the liquid staking thing, right? Sort of as I mentioned, right? You can see here on the left side, basically Ethereum, where there's a lot of liquid staking, and on Solana on the right side, right, where you have only around 5% of the tokens are being liquid staked. Again, I think that has a lot to do that the Solana staking experience is, really simple and works well, and so the benefit for liquid staking is more limited. The benefit for liquid staking on something like Solana is really like, hey, I want to use the token, I want to stake it and use it in DeFi too. And some people want to do that, but it's not actually, the primary thing that people want to do. Generally, they just want to stake and forget about it and earn their rewards. Yeah, but still, it's also something where we have, for example, an offering. This is pretty interesting, right? Because in the beginning, like Lido was really the dominant liquid staking offering. But now there's a lot more flexibility. There's a lot more products coming up. So, for example, there's also an offering we have now where you can stake with Course 1, but you can also liquid stake at the same time. So I'm going to talk a little bit about MEV. So MEV is an area that had a lot of attention in the last few years. I would say at the moment maybe a little overshadowed by some other areas, but it's basically has to do with when a validator creates a block, they have some influence on what transaction goes into the block, and that way you can basically generate additional revenues. And and the company Flashbot, right, they built the software to create an auction so that the rights to the block can be sold off to third parties and they can bid on it. And so this was kind of a controversial area, but of course in the end it is something where you have to assume that the people running the protocols are sort of going to do the profit maximizing thing, and then people designing the protocols sort of have to design an incentive that the thing works, even if people do that. So Ethereum has gotten very complicated too in terms of how blocks actually get produced. It's quite different from other chains. On other chains, it's basically like, you know, we as the validator, we get the transaction, order the transactions, create a block, and, you know, and that's kind of it. But on Ethereum, we've sort of taken this apart into different roles. So the proposer would be like us as the validator, but then we also have like a relayer, and then we have a block builder. And the block builder is basically the one who actually creates the block. So the transactions get sent to the block builder, they create a block, and they say, oh, this is how much this block is worth. The relayers send it around, and then the proposers kind of choose the one that pays the most and like broadcast that. So that's kind of the way Ethereum has sort of played out. And the MEV kind of also derives from optimizing processes around that and doing this in a sort of more efficient way. And this is something we've focused quite a lot on. And you know, we've kind of ended up building a sort of proprietary Ethereum version that does this in a more efficient way. So we measure a lot of data about the network and optimize different parameters, and then are able to generate, you know, higher MEV rewards. So I think over the history of running this, we've been doing it for a while now, you know, something like 9% additional staking rewards or MEV rewards on Ethereum. So yeah, we also published a bunch of like stuff on this, including sort of like an academic paper on the research behind it of how this works. So I don't have a lot of time, but I do want to talk a little bit about restaking. So restaking, basically, the high-level idea here is that, you know, when you're staking money, it's sort of locked up. And some of it is at risk, but some of it could be slashed if the node operator, the validator, misbehaves, and that kind of secures the protocol. But most of it is just there, and the slashing risks in reality are very low. Right? Like, we've never been slashed, and so we've never lost any money for anyone this way. And this is not untypical, right? In general, the amount of money that has been slashed has been really low. So of course, it's a good question to say, hey, we have all of this economic value that's being locked up here. Can we reuse this to do something else at the same time, earn additional rewards? So that's basically the high-level idea of restaking. Now, this idea has kind of existed for a while. We have this kind of thing running on Cosmos. There is something called interchain security that basically is already restaking. And of course, at the moment, you know, probably the most hyped project in Ethereum is a project called EigenLayer that's trying to do this for Ethereum staking. So you, as a staker, you can either do liquid staking or you could directly stake, and then you put you sort of restake your ETH, and then there will be basically different blockchains or different services called AVS that are then secured by this staked ETH, and where the user or the staker can earn additional rewards. So this is like one of the, I would say, one of the biggest areas of activity at the moment. I think on a high level, this category makes a lot of sense, right? It makes a lot of sense to say, hey, I want to earn additional rewards on all this capital that's being locked up there. But I think when it comes to, you know, the actual implementation of it, it's super early, and a lot of things are not figured out, and probably a lot of the designs that have been made maybe don't make that much sense. So I think it's going to take us years to actually figure out of how all of this works, and it's going to mean a tremendous amount of change and evolution, especially around Ethereum staking, I think, in the next years. And it's brought a lot of complexity to Ethereum staking. It's going to bring a lot of new products, new types of offerings that people are going to build. Let's see. Layer 2s, I think I'm going to skip this. Yeah, maybe just a final thing to briefly mention. in some networks, it's not for all networks, but in some networks, validators actually also play a crucial role in on-chain governance, right? So basically it means that, you know, someone can make a proposal and then the validators can vote on the proposal, and that's kind of how the network can make decisions in a decentralized way. This is especially the case for, and you know, there's different types of decisions. It can be a software upgrade, it can be there's a community pool and deciding how to spend the money, it can be just some text proposal about, I don't know, what's this chain for, or something like that. It can be parameter changes. So this is especially relevant on Cosmos networks. They basically all do that. Also some of the other networks, but you know, most of the activity we see in Cosmos. And you know, it's just an example of like the volume of activity here. So last year we voted in 1,246 governance proposals. So it's a huge amount of work too, of like looking at all these proposals, voting on them. But it's really actually amazing the level of sort of decentralized decision making that's already happening today on proof of stake networks, you know, using validators. So I think that's it. Yeah, there's a report on that if you're interested. But yeah, so I don't know if you have time for any questions. Or
We do, yeah. We have a few minutes. So who wants to start?
All right. Yeah.
Just 1 second, sorry.
Do you see any benefit in staking outside of like validators? So for example, you have a blockchain and you don't have validators there. For example, Optimism, if they decide to have like...
Yeah.
They would, for example, decide to have staking of OP token. Like, do you see any benefit of doing that if they don't have a role for validators to kind of pay rewards to?
Okay, so let me try to answer something that I think is sort of on this topic. I don't know if it's exactly your question, but I mean, sometimes staking gets used for like other things. People put out tokens in some sort of DeFi protocol and stuff, but there's actually no service being run, no protocol being secured. So I'm gonna like ignore this. But I think when it comes to things like Optimism or layer 2s, right? There we basically have the situation that these things generally are very centralized, right? Where you basically have like, you know, one sequencer that, you know, orders all the transactions, processes all the transactions. If they go down, you kind of rely on them. If they get censored or, you know, the government steps in, they could shut the chain down. And I think the thing that we're seeing is that all of these, or most of these roll-ups, they basically see this as a problem and they have a plan to decentralize this with time. And generally it goes in some sort of different steps, right? So first it's just one sequencer. Then they say, okay, we're going to have a set of like, you know, 5 different sequencers or something like that. And, you know, it's a approved list that they work with, you know, a little bit like the Lido set. But then I think many of them do want to go to a mode where it's like an open and permissionless system. And I think that's when you actually, what is this going to look like? It's probably actually going to start looking a lot like proof of stake systems again, you know, where you say, okay, someone has to lock up a bunch of tokens to guarantee that they're not going to do something malicious. And if they do something malicious, then they're going to be slashed. And you need some sort of consensus between the different sequencers to say, like, who's the one that's like sequencing right now and who comes afterwards. So I think our expectation, I would say, has been for a while that actually a lot of the roll-up space is going to kind of evolve in the direction to look more like proof of stake networks, and that we're going to have a lot of this kind of staking infrastructure function there as well. And it's not just there, right? I think we have that kind of role in other types of protocols too. I mean, for example, you know, we run also interoperability protocols like Wormhole or Chainlink oracles, and Chainlink's introducing staking as well, where they basically, again, want people to, like, you know, lock up tokens and they run the oracles, and if they do something wrong, they can be slashed. So I think that's kind of like a general paradigm that can be used for, you know, any kind of infrastructure operators to guarantee that they do it right and to allow a sort of open system where anyone can come in. Yeah.
Sorry, we don't have much time.
Maybe just
quick
question.
one. Okay. Just wait a second.
yes, interesting numbers. Do you have an opinion about solo staking? How can they compete?
Yeah, I mean, it depends, right? Of course, it's easy to, anyone can kind of like run a solo staker, right? And then I guess the question is like, how convenient is it? In terms of returns, I think, your returns might be a little bit lower, but I think your cost is definitely higher, right? So your cost is going to be higher, plus you have the sort of additional work around it. And I think what is also the case is with restaking, it is the case that it's actually becoming harder, I think, for solo stakers to compete, because now if you say, okay, you want to restake and you want to run a bunch of different AVSs, all of a sudden it's like now you have to run a whole bunch of chains. Or if you don't do it, then you will just make lower rewards. So I think it's definitely the case that I think solo staking is probably going to continue to be harder and less profitable with time. But I think it's going to continue to be an option, at least on Ethereum, right? Because I think they designed also the entire proof-of-stake system to try to make it easy to do solo staking. And was that a right call? I don't know, because I think it has a lot of other negative consequences. But I think that capability is going to continue to be there.
Thank you so much. If anyone else has any more questions, I think Brian will be around, so please approach him. And thank you so much, Brian, for your great presentation.
Thank you.
And right next, we can welcome Harry Roberts from Oasis. Harry will be speaking about confidential EVM and the next generation of contracts.
Yes. Yeah,
Thank you so much.
Do I have a clicker? Okay, so hi everyone, I'm Harry, I'm from Oasis, and we do a confidential EVM. So what that is, well, I think it's best to start with what a transparent EVM is. So you could call them transparent chains, so it's like Ethereum, Polygon, Arbitrum, and so on. And I guess like instead of confidentiality, you could call it private or a shielded EVM or like an encrypted EVM, but it's a small but sort of important distinction between the two. And but with a transparent EVM, the call data is not encrypted, so everyone can see what transaction parameters you're putting on chain. And even if you had encrypted call data, you couldn't decrypt it without everyone knowing the key. And then because it's verifiable and replicated, everyone can see the internal state of the contract. And you can add privacy to this, but you'd have to use something like a fully homomorphic encryption or like a little bubble of ZK privacy on top of that. At the moment, these are quite slow. So FHE is quite slow. With ZK snarks, you've got the proving overhead there. And but the good thing here is that if you wanted any of these properties on Ethereum, on a transparent chain, you end up with the small bubbles of privacy that you can go in and out of them, but as a whole, without everything being private and encrypted by default, you're losing a lot of the benefit of privacy there. So yeah, we made a confidential EVM. It's cheap, it's fast, simple, and you can program it using normal Solidity. So just like with EVM and Ethereum, you deploy your contracts on there, and it's all encrypted by default. You run the same computations as you normally do, and none of the data leaks everywhere. So I think I'll very briefly go through how do we do this. So it's been in production for about a year or so, and we're quite happy that it's getting some real-world use here. But to briefly go through how it works, if you're an expert in SGX, maybe I'm just fuzzing some of the details for brevity. But the contracts are running inside a secure enclave, so that's a trusted execution environment. And the enclave has like an encryption key, which rotates about once an hour, where the current secret for the key pair is only shared with the nodes who can prove, like via an attestation, that they're running the most up-to-date software. And this means that we have forward secrecy. So if a node drops out, their attestation stops being valid, they can't see what's going on in the future. And this attestation can only come from up-to-date Intel hardware, where there's like a cryptographically verifiable chain of signatures that ultimately come down to a unique certificate and a tamper-proof key pair that's embedded in the processor. And one of the things that we do is we have a compartmentalized key manager on the side there, where it's a different set of servers with a much limited, more limited footprint, and they very carefully delegate subsets of the keys to the compute nodes so that only the compute nodes get access to the data that they need to compute on. That means that there's no master key that's on the Sapphire compute nodes. And so essentially, as a node operator, I can't see the runtime state. I can't see the call data that's being passed to the contract. And I can see I/O on the disk, though. So yeah, I think the next point, though, is we have a confidential EVM that's great, but what can you do? What's the next generation? So we're going from the current set of ideas that we have for smart contracts. What can we do with this, and why do we need privacy? So I think it'd be interesting to think about, well, if you think about privacy, initially you think Monero, Zcash, but I think that's a pretty small part of it. And if you think about like protecting your healthcare data, that is pretty essential. So we're getting closer to why we need privacy. But essentially, privacy and confidentiality it's a part of everything we do every day or on every device. And it's pervasive. So the other problem is like data is a bit like nuclear waste or microplastics or sort of asbestos, where you can't really recycle or dispose of data very easily. And it collects everywhere in places that you don't necessarily expect. And once it's out there, you can't really put it back. So it took like 10 or 15 years for SSL to become a standard, and a handful of more years for like drive encryption to become the norm. So everyone's phones, their laptops are encrypted by default. But just as we started to encrypt all the devices and the servers, everything moves over to the cloud. And on the cloud, it's sitting basically unencrypted. So while the drives may be encrypted, the sysadmins can still see the data, the hackers can still see the data. And we have no idea, if the software that's accessing and modifying this data has been changed, or even, has it been deleted when we press the delete button. So now we're putting all this like unencrypted on the problem is now we're putting a lot of unencrypted data on the blockchain forever. And I like to think of this as being like the elephant's foot in the Chernobyl reactor, where it's like a disaster that's waiting to happen. And we haven't really had the marketeers take advantage of this. But I can imagine a slightly dystopian future where we're getting personalized recommendations based on my spending history, and then I'm being exploited and manipulated or something like that. And essentially, I'd like to live in a future where everything's private by default, rather than having to try very, very, very hard to make things private. But if we look at use cases, so privacy is one side of things, but there are situations where you really do need to hide information from other people. So one of those is like the bidding process and auction. So you can think of like a dark pool as being a continuous perpetual auction. And to give you a good example of without some degree of privacy or without a blind auction, if you have like all of the stock at the same time released onto the market, and there's a huge rush, you get lots of bots and scalpers. That creates pressure on gas prices, so the gas price increases, and this, the RPC servers may have problems, and other applications suffer on the chain. And all of that's because we have like an inefficient process of first come, first serve. I'm using blind auctions as an example because it's one of the examples in the Solidity documentation. So whenever we see this problem happening on chain, there's a solution to this already. But you can do it on Ethereum, and you can use a commit scheme, or you could do it on Sapphire, on a confidential EVM, and you essentially get blind auctions for free. So instead of having to design a scheme, you just write your auction contract as you normally would, and interact with it in private, and it does what it's supposed to do. There we go. So the other quick problem is that with privacy coins, I think it gets quite a bad rap, and I really want to say that 2025 is going to be like the year of privacy coins. So if we stop thinking of them as being like some kind of criminal element, or they've got a bad reputation, what about just my spending with my card? Can we have a serious pragmatic conversation with regulators to end up with the system that we already have in the real world, but on-chain? And I think it's the only problem there is that we don't want the regulators to take the benefits of DeFi out of this. But I do think we do need privacy on-chain for as many things as possible. The other question is confidential NFTs. So you can't really sell data if everyone can just access it and scrape the NFT database. So one thing we're doing with confidential NFTs is to be able to have information that only the current holder can see. So this allows you to have content gating, or like the high-resolution versions of it, or it can generate access URLs for so you can download it off of Amazon S3. And the other question is about like the fog of war and on-chain gaming, and you can't really upload all of the game data to the blockchain because it's just far too much. So a lot of people look at procedural generation of content, and if you have a procedural generation, a lot of people, you want the content to be new and to be exciting, but if you can see the seed that generates the content, especially if there's money at stake or if it's a play-to-win game, you can exploit the system by predicting what's going to happen, take one route or the other. And I think, I think the key point here is that when you have a confidential EVM that has like a built-in random number generator, you can keep the story secret, you can let things unfold, you can have like PvP battles where there is a bit of unpredictability. So you can do a face-off battle with somebody else, and you legitimately don't know what's going to happen. And the contract, because everything's running in private, it can play this out for you. And likewise with loot boxes, because it's on-chain, it's provably fair, rather than just being on some server somewhere. Now, to come to like the encryption and end-to-end encryption and AI, which is like a fairly hot topic at the moment, we do have one example of like a real dApp that's running on a chain that is using Sapphire for confidentiality. And that is, if you're making predictions, the value of your prediction is the track record of how frequently have you been correct. And if somebody else is able to see your prediction and copy you because they know you've got a good track record, the value of your prediction goes down because lots of other people are essentially just devaluing your effort. So this means that we have an app called Predictor by Ocean that you make your predictions, you can purchase the prediction feed, and it's all attestable, it's all on-chain, and so on and so forth. So we do have a sandbox and a playground where you can fork a bunch of different applications, lots of the front end set up. It's a really, really good point to get started and to sort of accelerate the development. So the next, to sort of get back on track, so we're doing confidential smart contracts. I do think this is like the next generation of things. And we do want to solve some bigger problems. So I want to think abstractly about, well, what is the current ecosystem? What gives value to the smart contract ecosystem? And how can this differ when you add privacy into the mix of it? Yeah, it's very important to have composability. So that's contracts that interact with each other and they're programmable, and functionality can be added on later by anybody. So that means you can make it do things that it wasn't initially meant to do. And if you have like a pluggable architecture, if you have to design everything up front and do it, design algorithms for this, or create a multi-party computation system, then that means that you have to think of everything everyone could possibly do up front. But with a confidential smart contract, this means that you can let it evolve over time. And especially when it's basically as fast as Ethereum is normally, but with added privacy, that means that you don't really get any, you're not weighted down by having to make proofs or having to set up lots of nodes for the multi-party computation. And it means that you can watch it evolve over time. But there are some sort of disadvantages in comparison to regular EVM. So one of those is that, well, now you're running in private, you could have a side channel. So the amount of gas that your contract takes can reveal the internal state of what code path it's taking. And also, we don't allow impersonations. On Ethereum, you can simulate a transaction from anybody and see what it does. But if you're in a private context, you don't want people to do that. So if I have my password manager on chain, I don't want someone to pretend to be me. So we do have to think about how do we create new authentication mechanisms. And one of those is like the login with Ethereum. So you have your login cookie that you pass to the smart contract to allow you to see your own data. And also, we can start thinking differently about how we can tackle problems. One of those is, well, in a private context, you can generate key pairs with the random number generator. You can sign with a variety of different algorithms. You can do encryption and decryption, and you can do hashing with algorithms that are used in the real world. And if we think of what could we really do differently, if both sides of two chains were both running trust execution, you could cut the bridge out entirely and just pass signed messages back and forth from each other. So I'd like to invite somebody on stage who is thinking differently and building on Sapphire to give us a couple of minutes of his time.
Thank you, Harry. So I think we have 4 minutes remaining, so I'll just quickly show what we're building and why we're using Oasis Sapphire. My name is Matthias. I'm the CEO and co-founder of Appelon. And what we're building at Appelon is basically abstracting all the blockchain logic and creating simple APIs for Web2 developers to enter the space of Web3. By us doing the heavy lifting, creating, let's say, the complete abstraction on different chains at the back end, and then creating SDKs like for JavaScript, TypeScript, Flutter, and so on, so we can start onboarding the next wave of users into the space. And talking about users, this is still the biggest issue, how we want to get the next million users who are not, let's say, Web3 natives, but are actually users who are using Instagrams, Netflix, and etc. today. This is still the biggest hurdle for Web2 developers to start onboarding them without exposing them to the, let's say, fiddling around with with the seeds, storing the seed phrases somewhere, storing them securely. So, So what we've done here with Oasis is basically, we're today launching the account abstraction SDK together with Oasis. So as a developer entering the Appelon platform, you're able to basically just call our SDK, we'll call Oasis, and Oasis Trusted Executable Environment will create a wallet on the behalf of the user and store the private key for the user. So the users never get actually exposed to managing or having to manage a private key themselves. Everything is done in a trusted executable environment. The keys are never exposed. But for the user perspective and for a developer perspective, they can normally onboard their user like email and password, Google sign-in, Facebook sign-in, whatsoever. But the user is equipped with a true Web3 wallet. The user, once they get more familiar with and once they're more in expert mode, they can start exporting their own private key from the wallet and take control out of it. But it's at least the first step to kind of start onboarding users, giving them the benefits of NFTs, loyalties, proof of attendance, incentives, and so on, what basically Web2 developers are seeking for, and how NFT technology basically should be used when we come to Web3. thanks to Oasis and having really this cross-chain compatibility, as an example, once a developer starts building an app in Flutter, they can say, I just want, the second the user signs on, I want the user to have an EVM address on Ethereum, on Polkadot, on Tezos, on whatever chain. You can just basically tick the boxes, and the users will get equipped with all those wallets, and they can start integrating those wallets into their Web2 application. From Apollon's perspective, so I encourage everyone to basically join our broad community of developers. So we've launched our platform back in February last year. We're now over 120,000 developers / users already on the platform, basically living the life or living the way in a very familiar fashion, like they use from Web2 world. So they're exposed with services like storage, computing, identity, smart contracts, but they never get actually in touch, or they don't see any Web3 terminology, right? So we do all the heavy lifting so that the Web2 developers coming into the space don't have to. So that would be from my side. Quick demo or an explanation of how we leverage trusted executable environments. If there are any questions for me or Harry, I'm happy to take any questions. Thank you.
Thank you both. Is there any questions in the audience? Not a single one? Okay.
Thank you.
Well, then you can also obviously reach out directly to both Harry and please remember... Matt?
Matt, it's the easiest.
Okay,
it's Matthias, but Matt is easier for anybody.
Thank you so much for your great presentation, and let's give us 5 minutes for the upcoming presentation.
Thank you.
I really
And up next, we have Dinam Preen from Enview. Dinam will be talking about modern blockchain indexing and syncing millions of events in seconds. Please give a round of applause to Dinam, and thank you so much for...
Thanks, Carolina. Very bright up here. Hallo, wie geht's? No, I'm just kidding. I'm from Cape Town. By a show of hands, who here has written a single line of code in their career? All right, and who's a day-to-day developer? They would call themselves a developer. All right, cool. Just getting an idea. Today I'm going to chat about modern blockchain indexing and what that looks like. So I'm going to start with just this teaser slide, and we'll come back to it, we'll unpack a little bit more. But it's just to kind of highlight that when I talk about modern indexing, we're working in a space where there's a lot more data than it used to be when blockchains started. And in order to index all this data, we need to apply some Web 2 technologies into the Web 3 space to really make this faster. But I'll come back to the slide. I'll touch on it a little bit more. First, a little bit about myself. My name's Denim, like the jeans. I'm the co-founder of NVO. I'm a believer in the tech and not the hype. My academic background's in computer science and economics. I'm an anarchist at heart. I can see the emojis have got a bit wonk. And I've been developing in the space since mainnet gas prices weren't so high. A little bit more about myself and the ecosystem. I'm a Puli holder, recently a Grounds DAO member, very cool DAO, if you want to check it out. It's a Nouns DAO fork about coffee. And I think most notably, I'm a safe guardian. Cool. By builders, for builders. Now, this is going to be maybe a little bit of a brag, but I just want to maybe add some credibility to who I am and the team I work with. But we are big builders at heart. We've attended several hackathons around the world, noted the first one in Cape Town, going to Denver, Bangalore, amongst a couple others. We've been fortunate enough to present at events in Davos, New York, Barcelona, amongst a few others too. And some of the smart contracts we've architectured have securely, for several years, held over $75 million in value. Excuse that slight brag. All right, so my talk on modern blockchain indexing begins with a story. So there were 3 little builders founding a Chad DeFi startup, and after a year in production, their data indexing would take a week to deploy. At the time, we were using subgraphs, and it was quite harrowing, or it was quite scary to think that if our indexer went down and we had to start it from fresh, it would take a week for our kind of back-end system to present data to the front end for it to deploy, which is quite a long time. And this is quite scary in the concept of going down, and we actually got a grant from the graph to build like a more robust version. It was called Subgraph and Crashable. And eventually we decided to take the leap and start building an indexer for ourselves. All right? And this indexer for ourselves, we felt was materially better. And so what we started to do was generalize it so that other applications can use it. Cool. Coming back to the slide, and we can unpack it for a little bit. This is the amount of time it takes to index a single Uniswap pool, and keep in mind there are thousands and thousands of Uniswap pools running benchmarks across a few different indexes. You can see with the graph on the one end, subgraphs, it's just under 17 hours, and with us, it's just under 10 minutes. So that's quite a noticeable jump. And what that practically looks like in the context of float, that's about 104x speed improvement. And so it took our 1 week deployment time into 1.6 hours, which is quite substantial and allows for a much faster iteration cycle. Just think about, when a product team comes to you and says, cool, we want this feature, and it's like, cool, I started working on it, it's done, it takes a week to deploy, and then say, okay, let's change it up a little bit. And you got to redeploy it, and then you have to tell them, oh, it's going to take another week. And this is quite a narrow example. in like a defined case where it was about a week. But for example, the Uniswap indexer takes about V2 takes about 40 days to deploy. So that's quite a substantial difference. All right, build bigger, ship faster. We have some of these stickers around, but I just use that to kind of break the flow. So at this point, we've chatted about why we need it, why we needed it, and we've touched on how much faster it is. But I think if we want to chat about modern blockchain indexing, we should dive into how we actually do it and what that difference looks like. So let's jump back a little bit. Let's take a look at how you get blockchain data. All right. So you get blockchain data from a node, and you usually make an RPC request, a remote procedure call. But essentially, you say, "Cool, node. This is the function I want to call. Fetch that data for me and send it back." And you can see in this diagram we've got the client and the blockchain node, and we've got two kind of example RPC requests there. I think it's meant to be get block and not get block data, and the second one is get logs. But essentially what's happening is you send a request, you tell the node what data you want to get, and it sends it back to the client. Now, this has two major bottlenecks. So we identified two major bottlenecks in this kind of process. And sorry, one other thing I just want to chat about as well. Maybe I'll get to it. Okay, so the two challenges were network and bandwidth, i.e. you sending data over RPC, and it's a lot of data you're collecting, so it's innately slow. You're limited by your internet speed. The second thing, which is a little bit more vague and open, is application design. So a blockchain node is designed for consensus. It's designed for kind of adding new blocks to the chain. It's not designed for getting data. However, it can be used for getting data. It isn't designed specifically to be performant in getting data. Now, something like get logs is a method you use to get event data when people interact with smart contracts, and that can build up over time. You can get quite a lot of events, so it can be quite a lot of data to transfer over. And so we identified this kind of challenge. Sorry, just to give you like maybe a very, very crude example of what this could look like, and don't shoot me, but essentially imagine you have 3 gigabytes of data you want to like collect, and you're storing it in a text file versus a database. It's obviously going to be faster to fetch from a database. Now, that's very crude, but I just use it for illustrative purposes to touch on that nodes aren't designed for getting data. So pretty straightforward. We developed Hypersync. And Hypersync, in the simplest terms, is a node designed for reading data. All right? So it's designed for querying really fast. We say mega fast, mega flexible, and real time, which is awesome. And what we did to kind of change things up, and a little bit more of the technical behind the scenes, we developed this node so it doesn't perform consensus. It's more of just a data lake, so it won't keep your blockchain alive, but it will be, it's kind of focused on getting data. And we really just applied a lot of Web 2 technologies to the Web 3 space. So we took modern database technologies and applied it into the Web 3 space. So here's kind of a simple example of something we implemented, which is called Parquet. And the way we store the data, so you might be familiar with kind of row-based records. We will store data in rows. And this, we shift it, and we store it in columns. Seems pretty simple. But interestingly enough, you're reading this data from disk. And so to search through disk, it's a lot faster if the indexes are next to each other rather than in a row-based format. Super simple, but really has some kind of notable improvements on how you get that data. The alternative would be if you could get everything into RAM, but if you look at something like Arbitrum, which is 7 terabytes for a full archive node, you obviously can't store 7 terabytes in RAM. So you've got to start optimizing for disk reading. Cool. Another thing, any Rust stations out there? Any developers in Rust? It's an extremely high-performant language that does some clever things with memory, and we built the system in this. This diagram I'm showing you here is actually just the comparisons between different clients, different nodes, and you can see how much Reth, which is a Paradigm recent implementation, is quite streaks ahead. You can see time to sync 50 hours versus the next app, which is 5 days, and Geth and Nethermind getting to 1 month. So quite a jump in performance. Another bit of the secret sauce, just to touch on Hypersync, is we implemented something called IO Uring. I won't dive into it too much, but with a package called Glomio, a Rust crate, we were able to optimize read and writes to disk. So again, some super powerful technology, but completely available and accessible, and it allowed us to increase the read and write speed to disk. Cool. So a lot of people think of indexing as similar to subgraphs, where you have an application, you've got events coming out of your contract, and you want to understand how your users interact with, and you aggregate that data. Now that, in this context, is hyperindex. And hypersync, what I've been chatting about now, is a kind of full representation of the blockchain. And so it's much more raw data, but it's the engine that plugs into hyperindex and allows us to index extremely fast. So that diagram I was showing you earlier, that was indexing specific events from a contract, from a Uniswap swap pool, and that's on hyperindex. And beneath the hood is this engine hypersync, and that's what we use to facilitate it to be so fast and be a lot more developer friendly. I also want to just give a special mention to HyperRPC. So HyperSync is our own custom API, and it's because RPC is unfortunately bottlenecked by network and bandwidth. And so what we did to make it a little bit more plug and play, a little more friendly to people trying to access data, is we put a RPC layer or kind of conversion on top of HyperSync, and so you can make normal RPC queries, and that'll automatically get converted into HyperSync queries behind the scenes. It works really nicely for plug and play, but unfortunately, again, it's still sending the data over RPC, and hence a little bit, we don't really get the speed optimizations from network and bandwidth. However, you can still search massive data sets and get the queries you're trying to get a lot faster. Cool. So definitely follow my co-founder, John. He's done some really fantastic examples of hypersync in action, specifically like aggregating or making queries into getting raw data, particularly good for analytics, other kind of applications you want to look into. And here he's got 2 examples. The one is in under 15 minutes, he was able to get 89 million transfer events on ETH mainnet for USDC. That's pretty impressive that within a kind of single query, you can wait a little bit and you'll have this response. The other example there is something I think super cool, is he's essentially passed in an address and got all the transfers and related to that address, and that's in 0.67 seconds. Now, with speed like that, you could build a block explorer with no backend. You simply get the data directly from the raw data directly from the chain, or hypersync in this instance. So really cool to see these. He's got 30 examples of this coming out, and they're coming out day to day, which is pretty cool. Definitely recommend checking it out. And then, yeah, we have kind of gone to market quite recently. We're quite a nascent product. We are getting a lot of really fantastic feedback, which has been pretty exciting. I think if you kind of read into this, it's like crazy how unbelievably fast your product is. It really just highlights that the feedback we've been getting is around speed, and it's been pretty motivating. It's been very exciting. And then wrapping up, we've got docs, everything in nvo.dev. You can check it out. The link to Discord, Twitter, etc. will be there. However, that's our Twitter handle, NVO Indexer, and it's also our YouTube handle. There's some really great speed runs, kind of 2 minutes to break down everything. And then that's my Twitter handle below, Denim Preen. Cool. Thanks, everyone.
Thank you.
Are there any questions?
Yeah, we have time for a few questions, so don't leave the stage yet.
Cool.
Yeah, does anyone want to start? Here's a question. Thank you, Cliff. Just 1 second.
thank you. Great presentation.
Thank you.
I was just wondering about some details. You were talking about indexing events on Uniswap version 3 pools, but it's kind of vague. If you simply retrieve and are able to basically query all the swap events, it's not that interesting. But can you reconstruct the internal state of the given pool from the events in that same amount of time? Like active ticks and where the liquidity is located, stuff like that.
I mean, so the hyperindex layer is you can kind of absorb the events and you can do what you want with those events.
I see.
And you can aggregate that into the...
You basically get a huge data set, right?
Yeah, so
okay,
I suppose hypersync is kind of like the raw blockchain information, and hyperindex is the layer above it in which you can choose how you want to aggregate your data into your database, and you can... but great question. You can store it as, you know, like how many deposits the user's made, what the total value of the deposits is, and you can get much richer data. At that level, it's a lot kind of easier at hyperindex, but sometimes you might have a custom use case. You need to do something specific, and then you can use hypersync, which is a bit more raw data, but much more flexible.
Thank you.
Cool.
There's an... Yeah.
Thanks for the talk.
Cool.
Is there a way to get access to raw data files? Because like you could analyze files on using AWS, Athena, or something
No,
like
absolutely, yeah. So hypersync, we've got 3 clients. So we've got a Python client, we've got a Rust client, we've got a JavaScript client. And if you use those hypersync clients directly, you can import the data you want into Parquet files, and then you can do a whole bunch of cool things. Like we've seen it plugged into ClickHouse, a few other applications. And then you can do your kind of data querying. Yeah. Cool.
Anyone else? We still have a few minutes.
All right.
Okay, then thank you so much, Denim, for your great presentation. And let's wait a few more minutes for the upcoming one.
Cool. Thanks,
you.
everyone.
Okay, thank you for waiting. We try to be straight on time just to make sure everyone is here. So up next we have Tomek Miercwa, I hope I'm pronouncing well, from Token Flow, almost. And he will be presenting about storage diffs as the ultimate source of truth for analytics. So please a round of applause from Tomek, for Tomek.
Hello, everybody. Thanks for waiting. Thanks for being here. Thanks, Envio, for the great presentation, and thanks for your question, because I will try to answer this question as well during my presentation. I'm Tomek. I'm co-founder and CTO of Token Flow, and I'm going to propose you a slightly different approach to on-chain data analytics that is based mostly on the storage information. Okay, it works. Okay. At Token Flow, we provide data. We provide data for complex use cases that require more data, more detailed data that you can get from events and calls. And what we do, we also try to be fully multi-chain, which means that we aggregate data from multiple chains into a single database. So all the analytics that you do, you can actually do across multiple chains at the same time. And I would like to focus mostly on our approach to analyzing data using the most important, the ultimate source of truth, which is the blockchain storage. As you know very well, every blockchain is actually about the storage. This decentralized ledger, it means that we have some data that we store, and it's changed in time by well-defined actions, like transactions. But actually what matters is what's stored in blockchain. How much tokens I have, what rights I have, what identity I have. Everything is written in the blockchain storage. And actions, like transactions, they change the storage. And actions, they emit events. Some of actions emit events, not all of them, and only in a way that was designed by developers. Because events are defined by developers in smart contracts, so you get events when it was designed by developer, and they contain the information that was provided by the contract developer. And events are very popular. Like the most of the data analytics today is based on events, and events are great. They're very simple to use, easy to use. They are well known, and if you look at the most of the dashboards, analytics, everything is about events today. But sometimes events are not enough, and sometimes events are not good. I will even say that events are bad. I will try to give you a little bit more context for this. As you know very well, events cost gas. To emit event, you have to pay for it. And today, this cost becomes important, and more projects, they started to think how to reduce this cost and how to stop emitting event or limit the number of events that's emitted by the contract. Even today, we talked to one of the projects that's building the DEX that is by design eventless. It will not emit any events. And probably some of you are also familiar with the concept of shadow events. This is the nice concept introduced like a year ago, which is approach that is based on adding some new events to existing contracts in parallel implementation of the blockchain. So you take existing contract, you modify this contract, you run this in parallel environment, and you can emit your own events. Whatever you want, you can include in this new smart contract. And this is the trend that you can see on the market, that people are looking for a way to avoid costs that is related with emitting events today. And this is one problem. One problem you are going to see less and less events going forward in the new contracts, new implementations. Another important problem is the fact that they are developer-defined. So you get in the event what developer wanted to show you. And you have to trust developer, or you need to deeply understand the whole contract to be fully sure that everything that you get in the event is actually complete, it's true, because it's something that's developer-generated. Event is not the contract storage. Event is just some representation of what happens in the action provided by developer. Another problem is, even if developer is fully trustful, all events are great, still sometimes you may find a need to change existing event, to add some additional information to existing event, or to add new events to smart contract. And you cannot do it, right? You cannot do it today, because events are implemented in smart contracts, so you cannot change it. So our maybe bold argument is that events are actually completely redundant and completely unnecessary, because everything that you get in events, you can get from contract storage, which is not easy, but it's possible. Because the storage is the ultimate source of the truth. Everything that's important is in the storage. And if you imagine, if you have access to every single change in storage history, you can get exactly the same information that you get from events and much, much more. But working with storage is very hard. This is the reason why so many people today use storage for analytics. The blockchain nodes were designed, as Envia said before me, for doing different things, not for getting the data out of the node. And getting storage data is the hardest part of it. Problem is, storage is very hard to extract from the blockchain. Storage is implemented in a way that makes it really, really hard to work with. First, the most important problem is, as you know, most of the storage is in the hashed form. If you have the hash map, so you have slot and keys, for example, you have balance of address, it actually gets hashed, and this is how it's written in the blockchain storage, and it makes it not usable at all. This is the reason why everybody says that you cannot iterate over hash maps. You cannot ask the contract for a list of holders. This is because the storage is hashed. Another problem with storage is that it's completely unstandardized. For events, for example, if you have ERC20 events, you can expect some standardization. You can expect the transfer events will be the same for every token. For for storage, there is no standardization at all, so everybody tends to implement this in a custom way. Also, this is this problem of, as I called it, semantic ambiguity. It's because the same storage, the same physical storage, can be interpreted differently. It's not me. Interpreted differently by two different implementations of the same contract. Imagine if you have the diamond pattern. So you have one proxy that calls multiple implementation. They all work on the same storage, and the meaning for the storage element can be different for different implementations. Storage is huge. If you take all possible variables of all smart contracts and multiply it by every action, you get really, really huge volume of data that's actually not possible to work with easily. And also working with storage is hard. Like analyzing storage is hard, because events are very simple. We learned how to work with events, but working with storage is hard. And what we do, we try to provide a solution for this. So our approach, what we do at Token Flow, first of all, we implement the custom tracer for EVM chains, which means that we use standard node, but with custom tracer, which can be implemented in the node. And it enables us to get every single storage diff in pre-hashed form, which means that we have access to every situation when anything in blockchain storage was changed. And it's even true for the transient storage that was introduced recently with the latest hard fork. So we have every single change, and it's in pre-hashed form, so it's actually usable. Then the next step is storage decoder, that it tries to make this very complex information usable by exposing all the keys, maybe also the variable names for verified contracts. So we expose the storage in the form of storage diffs at the lowest possible level. And then we build this multi-chain data warehouse, which has what every other blockchain data warehouse has. We have all the blocks information, transactions, internal calls, events, but also this storage diffs information. On top of this, we also provide some analytical front ends for analyzing this data. But still, it doesn't solve the problems of complexity. We learned hard way during the last few years working on this, that even if we expose all this storage information, it's still hard to work with this. It's still quite cumbersome, and you need to have like very deep understanding of contract logic, and you also need a lot of SQL skills to actually build any queries on top of this storage. So today we are trying to introduce a completely new concept that we call ecos. And ecos are artifacts that are similar to events, but they are built directly on storage information. So we take what we have, like every single change that ever happened in blockchain storage, and on top of this, we build additional layer of processing that simply transforms this raw information into something that looks like events. So these are the artifacts that are emitted in specific moments in processing, and these moments are unlimited. We can send echo at the beginning of the block, at the beginning of transaction, when specific storage variable is changed. We have full flexibility when we emit such echo, and we have full flexibility what we include as the content of the echo. So think about ecos like events that are generated directly from storage information. Of course, it happens in post-processing, which means that we have all the storage diffs information, and then using this data, we build some formulas to generate ecos. This is very important because this happens in database, which means you can easily build echo that you can calculate historically for the whole history without any need of reprocessing data, because all the data is there. You just apply some database operations to calculate this using the storage information. That's like the basic thing for doing anything about it. Ecos, as I said, they are directly generated from the blockchain state. We have access to every single change in blockchain memory. We have access to every action, every transaction, every call, even to existing events. We can build ecos on top of existing events. Think about transfer event. You can amend existing transfer event, and every time when transfer event is emitted, you can emit echo, which has exactly the same information, plus additional things like token name, token decimals, receiver balance after the transfer, sender balance after the transfer. You can add multiple things just to existing event. As I said, they can be generated for history, just by database operations, which means it's relatively fast and cheap to generate them. And because we have access to whole history, we have full flexibility when, in which moment of processing we plug such echo and what we include into this. At the end of the day, you get something that looks like events. So artifacts that are precisely like hooked in time and have some dimensions, some measures that you can use for your analytics. What's very important, such approach gives us access to variables of every contract on the blockchain. So you're emitting echoes from one contract, but at the same time you can query storage of every other contract on blockchain. And if you think about it, you can also build multi-chain echoes. So you can, for example, generate swap echo that has all the information that typically are included in swap event, but you can add also on-chain price, and you can add on-chain price on other chains as well. Because if you have everything in the same database, and you can align those blockchains with time, you can extend the content of echo with information from other chains as well. So this gives us this ability of easily generating multi-contract, multi-blockchain artifacts that then you can use for your analytics exactly as you do it with events today. Some very simple examples. Think about signer change echo. We trigger this by change in the storage, in the hash map that stores the list of signers for a wallet. So we don't care how complex is the wallet smart contract, how many calls you may have, how many events are generated. We are looking exactly at one specific piece of storage, and every time when we change something in the signers list, we emit echo, which contains information about time, sender of transaction, for example, signer address, type of change, was it adding or removing the signer, cost of gas, whatever you want to add to this. We have full flexibility. Another example, I call it whale transfer. We look at the Pepe token, and we want to emit echo every time when there is a change of balance for holder that holds more than defined number of Pepe tokens. So define when you do it and what's the condition for generating such echo. And again, you can include whatever you want, like time, function that was used to change the balance, sender, recipient, amount, sender balance, post-transfer, recipient balance, post-transfer, USDC price of Pepe, on-chain price of this token, transaction sender, gas price, gas used, sky is the limit. So we believe that this approach gives us completely new abilities because we can analyze the full blockchain data and we can get this information that's very important because analyzing storage is the core of many analytics today. And what we do today, think about it. If you want to have the balance of a token in time, what people do? People take the millions of transfer events and aggregate them in time just to recreate the balance at any point in time. With this approach, you have access directly to the balance. You don't have to remember what types of operations can change balance. You know very well that for USDT and for WETH, it's not enough to take transfer events because you need to also take deposit and withdrawal events. to recreate the balance. So you need to have additional knowledge about how this storage is changed. With this approach, you work directly with storage. It is much easier at the end of the day and much more reliable. And also, what's very important, you see what you want to see, not what somebody wanted to show you. So this is this approach that requires very detailed storage history in pre-hashed form, but this is what we have today. We have this information, and on top of this, we are building this additional layer that enables actually to use it for analytics in a way that's similar to well-known events. So thank you, and I'm open for questions.
Thank you, Tomek. Any questions? I think there's some right there.
Thanks, Tomek, for the talk. So my question is, do I understand correctly that you have traces, right? So that you have to run your archive node and have your custom trace. And like, I'm trying to understand how do you get the context for this storage change. So like you identify moments in time when storage changes, but
yes.
you also need this additional context to be able to construct echoes. So like, do you take it from traces? Like that's why.
Yeah, that's very important part of it, because when you execute transaction, you execute transaction as a whole. It contains inside the internal calls, right? You execute them one by one, and every internal call, it may have multiple storage changes and state changes. We distinguish storage and state. State is like the ether balance, nonce, and storage is the smart contract variables. So when you execute every call, you have the potential storage diffs that are ordered. And keeping this order and also being able to align this with the order of calls, order of events, gives you this ability that you know exactly where in this processing stream this operation happened. So if you, for example, generate your echo on the change of the storage variable, you know which change it was, like it's in the context of this specific call, this specific transaction. So this is very important to have not only access to this storage information, but also this context, as you said, which means like which transaction it was, which call it was, what is the overall state of the whole blockchain, and this is exactly in the data. So every action, and by action I mean transaction, call, emitting event, or changing storage, it's ordered, so you exactly know when it happens in this execution plan. So yeah, and you can, this is very important, that you can use all this information. You are not constrained with the scope of information that you can include in this generated artifact. Another important point here is that normally if you work with the node, you can get the storage information at the block level. So if you, for example, you have the get storage at RPC function. So you provide the address, which is hashed with keys and stuff, so you need to know keys to actually do it. And you provide block. And it gives you the storage at the end of the block. So you are blind to what happened inside the block. With our approach, as I said, we have every single change. So it's an enormous number of information, but you cannot hide anything. If you change something at the beginning of transaction and reverted this back at the end of transaction, normally you will not see the change in the node, because from node perspective, nothing changed in this block. We see that it was changed to something and then reverted back to the original value. And as I said, everything is ordered, so you can easily get this context for every echo. Hope it answers.
We have time for one question. Short answer, please. No worries, no worries.
Thank you, great talk. I have a lot of questions, but I don't want to bore anyone, so I'll limit myself to a really short one. Time and space. how much space all of this stuff does take, and how quickly can you answer a query? For example, I have a contract, I have a storage slot, I want to know the value of the storage slot at a given point in time.
Let's take Ethereum as an example. This is the big chain. So the whole processing, because as you mentioned, this requires like the initial processing. You cannot easily get this information. You have to reprocess every single transaction. And this reprocessing takes some time. For Ethereum, it took us around a month to process the whole history. But we do it only once. Like if we do it once and we do it well, we never get back to this. Then we process head, which is easy because it's not so much data, and we update the database a few blocks behind the tip of the chain. The whole database for Ethereum today is around 100 terabytes, I think. And the speed of querying, of course, it depends on how much money you can throw at it. Because we store this in multiple databases and
distributed, yeah.
And for example, in Snowflake, which is one of the distribution channels, you actually can define what size of warehouse, the computing power you throw on this query. So if you want to pay small money, it will take longer. If you pay big money, it will take it will be faster. But with reasonable size of the warehouse, you get the answers in seconds. So this is what you actually need for your analytics. This requires some good understanding how to build the SQL queries to do it. And one of the things to provide this ecos is to do it for you. So the standard way of processing storage is kind of hidden for you, and you are seeing something that looks like events. It just includes the storage information in the events. So it's a huge data. It's lots of processing, but first it's doable. And it's in reasonable time. It's not something that you cannot use for analytics and actually working with this data. And it's live. It's for a few chains. We have it. We are adding more and more chains. And we can do it for every Geth, Aragon-based chain. We are also working on Red. So every blockchain that uses this technology can be easily processed just by adding this additional tracer.
I see, thank you.
Thank you so much, Tomek. Any other questions, you can always approach Tomek. We'll
if you
be
want
around.
to talk, I'm here, and we also have booths down there, so we are open for any kind of questions. Thank you.
Thank you. And up next, this is our last presentation of the day, so please be patient. We are almost wrapping up. And we will have Fig from Squid, and he will be talking about cross-chain abstraction under the hood. So please give a round of applause to Fig, and welcome to the stage.
Hey guys, I'll just check that this is working. There we go. All right, so I'll be talking about cross-chain abstraction today. We live in a world which has a lot of variability. We have new chains popping up all the time, new innovations, new virtual machines, and this is a good thing. We like the diversity. The reason that we have innovation in the first place is because new technologies can launch and then gain new users through these permissionless means that we like in Web3. And what this ends up with, though, is for the user's point of view, you have treacherous terrain that you have to cover, and you end up with just wanting to do one small thing on an application. You have to do 10 steps, go to 5 different websites. You're worried about getting hacked, get gas, whatever. We all know this so well. It's actually been a problem since back in 2020 when we started seeing chains other than Ethereum launch. And I'll be talking about how to solve this problem today. So you think that one chain where you can keep all your assets and put all of your expressions of your intents, like whatever you want to do, would be the answer. But I think that is slightly myopic. What this might look like is, I'll just see if I can go back with this pointer. I can. So we want this diversity, right? We don't want Mordor to become the only ruler of the entire Middle Earth, or one technology to rule everything. In Web 2, we have Visa and MasterCard are the only payment rails for everything, and we're locked into this technology, which is from the 70s. We want the infrastructure layer to be just as permissionless as at the application layer, where you can plug any smart contract into any other smart contract. And so we need to go back to what's important so we can build cross-chain in the same way that Bitcoin was originally built. So Bitcoin gave us ownership, true ownership, where no one can take a value away from you, and you can use that value to transact with whoever you want, however you want. That's what I'm defining as interoperability here. Bitcoin actually had amazing interoperability in the sense you could send money to anyone or receive it from anyone. And when Ethereum came along, this goes up a layer, and you have ERC20s, where you have different currencies like USDT and Ethereum. And interoperability here requires a market. And that's what Uniswap gave us. It gave us interoperability at one derivative up away from Bitcoin. So we have Ethereum, ERC20s, Uniswap, allowing us to transact with anyone in any currency. And the quest of the day is we have cross-chain, and how do we have true interoperability now, not only with different currencies, but different virtual machines, different gas models, different ways of getting data. And what that looks like is a combination of all of the layers below. So Uniswap's involved, ERC20s are involved, but now we have bridges and cross-chain swap applications and APIs. And I'm from a project called Squid, which we do cross-chain APIs and developer tools. And Axelar is a project we work really closely with, who's a bridge and general message passing protocol. So this is how I've broken it down. Like, consensus is essentially social consensus enforced through protocols, and you bring that all the way up to Ethereum's protocol and now cross-chain protocols. And with the market, Squid's handling cross-chain swaps, Uniswap's handling on a single chain. And really importantly, the application layer is exactly the same from the user's point of view. They shouldn't have to be aware of any of the stuff happening underneath. So you may think or have heard that intents are the answer to this problem, and intents are great. This is a provocative title, but they're not the full answer. And it's evident, especially with meme coins, where an intent market is less likely to pick up liquidity and pick up sort of demand for a meme coin so early on. Something like pump.fun is a transaction model, and it allows anyone to enter the space with a little bit more censorship resistance than intents. And if we think of intents as the solution to back at the start, you might think we have one chain where you express your intent, you keep all your value there, and then solvers go and magically do all your actions for you. You lose a bit of the ownership because you're now trusting a bridge to own a bunch of your assets, and also this intent layer gets a bit of lock-in. It's whatever the intent layer can support, or whichever bridges it supports, determine the only chains that you can interact with. And you want to be able to download a new wallet and interact with a chain if you want to. So intents aren't the full answer, but they do give us really good properties for cross-chain. They speed everything up and give you almost instant settlement, and they let you get off-chain liquidity, which is great for when you have assets which are also supported on Binance and other exchanges. You get similar prices. We use intents in Squid. This is a roller coaster that we sponsored because in the bear market we couldn't afford to sponsor an F1 car. And we had a race with all of our users, and people were hitting sub-second cross-chain swaps, and people have saved years at this point using intents on Squid. And so intents are part of the answer, but the issue is that with true abstraction and being able to absorb all of this change, you have all of these things that the solution needs to handle. It's like gas, different virtual machine, wallets, different liquidity, different token types, getting balances, how do you get data, transaction roll-ups, like putting everything into a single click. And this is all that you have to do now, but imagine, ZK is going to probably create some amazing cross-chain opportunities. You'll need a system which adapts to all of the new innovation that's coming. So I think the answer is actually to use a combination of developer tools which are constantly able to constantly change as well. And that's how we're approaching it at Squid. We have an API which gives you these transaction rollups, and that's constantly absorbing new types of DEXs, new bridges, new cross-chain methods. An Explorer API which aggregates all the explorers, different RPC data. We have indexing across like 60 or 70 chains. We use intent models, we use transaction models. We have hooks for doing things like buying an NFT on another chain. Anyone can program whatever they want. And we have SDKs for on the front end side, because you have different wallets. You have to get balances on the front end. Like, there's just so much complexity always happening that I think a constantly changing set of dev tools is the answer. And these are some of the use cases. It's all the same, a single chain, but you can do it cross-chain. We've built our own checkout where you can buy any NFT on OpenSea in one click with any token in your wallet. And we've built a chat-based interface where you can just type whatever you want to do, and you can do that on any chain. So you can build the same applications as single chain. And yeah, that's all. I'd love to chat to anyone if you have questions, but thanks for having me.
Thank you. We do have time for a few questions, so
Sure.
If anyone wants to make some, feel free to. Otherwise, yeah, Fig.
Oh, we got one.
Sorry. I didn't saw it.
Thanks for the presentation. That was good. You mentioned about buying an NFT on another chain. I wanted to ask an example. Say I have funds on chain. I'm on chain A, and there's a platform on chain B, and I have funds on this chain A. Can I, using that SDK, buy something on chain B, given that I'm on A and with funds on A?
Yeah, exactly. The way that we do it is with we call them post hooks. So you get the call data for purchasing the NFT on a single chain, and you pass that in as the post hook, and then in front of that you have the route for the swap between the token you have and the token you need to buy it. So in this case, say I have Magic on Arbitrum and I want to buy a Milady on Ethereum. What's happening here is you get a quote for swapping Magic and ETH across chain, and then you add the post hook for buying the NFT, which is just a normal, like, buy on OpenSea. And yeah, it happens in under 20 seconds. You just buy it as you would normally. Yep, with any token.
Anyone else? Okay. Well, thank you so much for your presentation again.
No worries.
A round of applause. And yeah, this was this is the wrap up. So this was the last presentation of today, and tomorrow we'll be back at 2 p.m. on this stage and at 10:30 on the main stage. So I'll see you all tomorrow. Thank you so much.